down. Sell short when SROC turns down from above its center line. 3. If prices reach a new high, but SROC traces a lower peak, it shows that the market crowd is less enthusiastic even though prices are higher. A. Bearish divergence between SROC and price gives a strong signal to sell short. 4. If prices fall to a new low but SROC traces a higher bottom, it shows that the market crowd is less fearful even though prices are lower. 29. Williams percent are 151, 145, 138, 138, 123, 115, 106.18, 101.93, 97.68, 93.43, 89.18. Figure 28, 4. Smooth rate of change, SROC 13/21. To create this indicator, calculate a 13-day exponential moving average of closing prices and apply a 21-day rate of change to it. SROC usually flows in smooth waves whose crests and bottoms identify many emperor. This indicator works especially well in the stock market, with stock groups as well as with individual stocks. Shows that the downside pressure has lessened, even though the market has fallen deeper than before. A bullish divergence gives a strong signal to cover shorts and buy. 29. Williams percent R. Williams percent R, WM percent R, is a simple but effective oscillator described by Larry Williams in 1973. It measures the capacity of bulls and bears to close prices each day near the edge of the recent range. WM confirms trends and warns of their upcoming reversals. HRC, HRLR, WM równa się 100. 152 computerized technical analysis, where equals the time window selected by a trader, such as 7 days. HR equals the highest high of the selected period, i.e., a 7-day high. LR equals the lowest low of the selected period, i.e., a 7-day low. C equals the latest close. WM percent R measures the placement of each closing price in relation to the recent high-low range. It expresses the distance from the highest high to the lowest low in its time window as 100%. It expresses the distance from the latest closing price to the top of that window as a percentage of the range. In its window, see worksheet. Figure 29.1. Williams percent R is closely related to stochastic. See section 30. WM percent R is designed to fluctuate between 0 and 100%. It equals 0, plotted at the top of the chart, when bulls reach the peak of their power and close prices at the top of the range. It reaches 100% when bears are at the peak of their power and close prices at the bottom of the recent range. A rule of thumb with all oscillators, when in doubt, make them shorter. This is the opposite of trend-following indicators. When in doubt, make them longer. Oscillators with narrow windows help catch short-term rever sales. If you work with cycles, make WM percent R equal half the cycle length. A 7-day window fits WM percent R fine. WM percent R works well with weekly charts. Use a 7-week window. Horizontal reference lines for WM percent R are drawn at 10% and 90% levels. When WM percent R closes above its upper reference line, it shows that bulls are strong, but the market is overbought. When WM percent R closes below its lower reference line, it shows that bears are strong, but the market is oversold. Crowd psychology. Each price is a momentary consensus of value among all market participants. The high of the recent range shows how high bulls can lift prices. It reflects their maximum power. The low of the range reflects the maximum power of bears during that period. Closing price is the most important consensus of the day because the settlement of trading accounts depends on it. WM percent R compares each closing price to the recent range. It shows whether bulls can close the market near the top of the recent range or bears can close the market at the bottom of the range. WM percent R measures the balance of power between bulls and bears at closing time, the crucial money counting. Time in the market. Bulls may push prices higher during the day, or bears may push them. 29. Williams percent R 153. Gold. Low close WM percent R 7. 358.2, 361.2. August 15th, 360.2, 360.4. 361.6, 360.3, 361.3. August 19th, 366.5, 360.4, 362.0 high BHBBM. PR 3 fem 3 3 fem ni 3. 358.2, 360.1 SAM. August 22nd, 359.9, 357.4, 357.5, 80.36. August 23rd, 357.2, 355.3, 356.7, 87.50. August 26th, 357.1, 358.571.43. August 27th, 358.8, 356.9, 357.8. August 28th, 359.5, 356.1, 357.370.15. August 29th, 353.7, 354.194.03. August 30th, 351.5, 348.5, 351.474.56. September 03, 352.6, 349.4, 351.671.82. September 4th, 352.3, 351.6, 351.8, 70.00. 9/05, 350.7 HESSSM, 350.3, 83.64. September 6th, F, 352.5, 349.8, 352.365.45. September 9th, 355.9, 353.4. Figure 29.1. Williams percent, our worksheet. WM percent R expresses the distance from the latest closing price to the top of the 7-day high-low range as a percentage of that range. WM percent R 7 is cal. Calculated here using a 7-day time window. You may choose a longer or a shorter window, depending on the trend you're trying to analyze. Lower WM percent R shows which group is capable of closing the market in its favor. If bulls cannot close the market near the top during a rally, they are weaker than they seem. This is a shorting opportunity. If bears cannot close the market near the lows during a decline, they are weaker than they appear. This is a buying opportunity. Trading rules. WM percent R gives 3 types of trading signals. They are in order of emperor: TANTs, bullish or bearish divergences, failure swings, and overbought over. Sold readings. Figure 29.2. 154 computerized technical analysis. 378.6. 379.3. 3. 2.0. 353.6. 345.3. 0.00. 25.00. 50.00. 75.00. 100.00. Figure 29.2. 7-day Williams percent R, WM percent R, 7. When WM percent R rises above its upper reference line, it shows that the market is overbought. When it falls below its lower reference line, it shows that the market is oversold. The best buy and sell signals are given by divergences marked by arrows. A Class B bearish divergence in July gave a sell signal. A class of bullish divergence in September gave a strong buy signal. Failure swings, marked by the letter F, occur when WM percent R reverses without reaching its reference line. This happens during reactions against very strong trends. Failure swings confirm those trends. A failure swing during a downtrend in August gave a strong sell signal. A failure swing during an uptrend in September gave a strong buy signal. At the right edge of the chart, prices are surging. If WM% are dips below its lower reference line, use that as a buying opportunity. Do not sell short unless a bearish divergence emerges. Divergences between prices and WM% are rarely occur. They identify the best trading opportunities when WM% are rises above its upper reference line, falls, and then cannot rise above that line during the next rally. It creates a bearish divergence. It shows that bulls are losing their power in the market. 29. Williams IR 155 is likely to fall. A bullish divergence occurs when WM% are falls below its lower reference line, rallies, and then cannot decline below that line when prices slide again. It shows that bears are losing power and a rally is in the offing. 1. When you identify a bullish divergence, go long and place a protective stop below the recent price low. 2. When you identify a bearish divergence, go short and place a protect stop above the recent price high. Failure swings. Crowds tend to swing from one extreme to the other. Vwem ir seldom reverses in the middle of its range. Failure swings occur when WM% are fails to rise above its upper reference line during a rally or fall below its lower reference line during a decline. 3. When WM% are stops rising in the middle of a rally and turns down. Without reaching its upper reference line, it produces a failure swing. This shows that bulls are especially weak and gives a sell signal. For when WM% are stops falling in the middle of a decline and turns up, without reaching its lower reference line, that is a failure swing. It shows that bears are very weak and gives a buy signal. Overbought and oversold. When prices close near the upper edge of their range, WM% are reaches its top and becomes overbought. When prices close near the bottom of their recent range, WM% are falls and becomes oversold. Neither bulls nor bears are all powerful. They seldom can close prices near the extreme of the recent range for too many days in a row. 5. When WM% are rises above its upper reference line, it marks a potential market top and gives a sell signal. 6. When WM% are falls below its lower reference line, it marks a potential market bottom and gives a buy signal. These overbought and oversold signals tend to work well during flat trad. Engineer reinvest. They become premature and dangerous when the market enters a 156 computerized technical analysis. Trend. WM% can stay near the top for a week or longer during a strong rally. Its overbought readings can identify strength rather than a shorting opportunity. Similarly, in a strong downtrend, WM% can stay oversold for weeks, indicating weakness rather than a buying opportunity. Overbought and oversold readings of WM% should be used for trading only after you identify the major trend. Use long-term trend following indicators for that purpose. See section 43. If a weekly chart shows a bull market, take only buy signals from daily WM% and do not go short when it gives a sell signal. If a weekly chart indicates a bear market, sell short when, but a wider window helps identify major turning points. 2. The second step is to obtain %D. It is done by smoothing %K, USU, ally over a 3-day period. It can be done in several ways, such as 30, stochastic 157, 3-day sum of TADLN, %D également astérisque, 3-day sum of HNLN. There are 2 ways to plot stochastic, fast and slow. Faststochastic consists of 2 lines, %K and %D, plotted on the same chart. It is very sensitive to market turns, but leads to many whipsaws. Many traders prefer a less sensitive, slow stochastic. The %D of fast stochastic becomes the %K of slow stochastic and is smoothed by repeating step 2 to obtain %D of slow stochastic. Slow stochastic does a better job of filtering out market noise and leads to fewer whipsaws. A 5-bar slow stochastic, smoothed over a 3-day period, is a popular choice among traders. See worksheet. Figure 31. Swiss franc. Date 4.YD. Low close 1% K. 5% D. 5 slow percent D. 67.24. 168.22, 67.79, 67.97. KJJPFL I 67.61. 167.52. 66.81. 67.02. 67.36. 67.25. L. 9/20. September 23rd. 167.57. 168.21. 66.87. 67.89. 67.50. 68.04. I 48.94. 187.23-4 asterisk. S. Inni 24 deler I 68 536 748 6 424 underscore 360.57. 167.8. 767.5, 767.71, 50.60, 360.54. 1 KMI. 67.97, 67.58, J 42.77, 47.22, 56.11. I 68.30. 168.49 millimeters, 68.23. 68737. 74.14. T 86.21. 3. 53 to 79. 64.57. 53.85. 55.20. Figure 31. Stochastic worksheet. The percent K of fast stochastic is similar to Williams percent R. The percent D of fast stochastic is obtained by smoothing percent K over a 3-day. The percent D of fast stochastic becomes the percent K of slow stochastic and is smoothed once again to obtain percent D of slow stochastic. Most traders use computers to construct stochastic. Choosing the width of a stochastic window depends on a trend you are trying to identify. A very short-term stochastic, 5 days or so, helps catch short-term reversals. A longer stochastic, 14 to 21 days, helps identify more significant market turns. 158 Computerized technical analysis. Stochastic is designed to fluctuate between 0 and 100. Reference lines are drawn at 20% and 80% levels to mark overbought and oversold areas. Slow stochastic seldom reaches the same extremes as raw Williams. Crowd psychology. Each price is the consensus of value of all market participants at the moment of transaction. Daily closing prices are important because the settlement of trading accounts depends on them. The high of any period marks the maximum power of bulls during that time. The low of that period shows the maximum power of bears during that time. Stochastic measures the capacity of bulls or bears to close the market near the upper or lower edge of the recent range. When prices rally, markets tend to close near the high. If bulls can lift prices up during the day but cannot close them near the top, stochastic turns down. It shows that bulls are weaker than they seem and gives a sell signal. Daily closes tend to occur near the lows during downtrends. When a bar closes near its high, it shows that bears can only push prices down during the day but cannot hold them down. An upturn of stochastic shows that bears are weaker than they appear and flashes a buy signal. Trading rules. Stochastic shows when bulls or bears become stronger or weaker. This information helps you decide whether bulls or bears are likely to win the current fight in the market. It pays to trade with the winners and against the losers. Stochastic gives 3 types of trading signals, listed here in the order of importance: divergences, the level of stochastic lines, and their direction. Figure 32. Divergences. The most powerful buy and sell signals of stochastic are given by diver. Janks between this indicator and prices. 30, stochastic 159, 8.53, 7.88, 5.48, 3.9, 2.43, 120.80, 90.08, 0.00, 30.80, 0.00. Stochastic lines help identify top and bottom areas when they move, above or below their reference lines. These signals work well during trading ranges but are premature when a new trend begins. See early. September. Stochastic gives its best signals when it diverges from prices. There is a class of bearish divergence in early October prior to a sharp price break. Once you go long or short using stochastic, place a protective stop immediately below the latest minor low or above the latest minor high. There's a buy signal at the right edge of the chart. It is time to cover. Shorts and buy. Ash on SSEI. EQBB buy. Eliasup. Figure 32. 5-day, slow stochastic. 1. A bullish divergence occurs when prices fall to a new low, but stochastic traces a higher bottom than during the previous decline. It shows that bears are losing strength and prices are falling out of inner TIA. As soon as stochastic turns up from its second bottom, it gives a strong buy signal. Go long and place a protective stop below the latest low in the market. The best buy signals occur when the first bottom is below the lower reference line and the second is above it. 2. A bearish divergence occurs when prices rally to a new high, but stochastic traces a lower top than during its previous rally. It shows 160 computerized technical analysis that bulls are becoming weaker and prices are rising out of inertia. As soon as stochastic turns down from its second top, it gives a sell sig. NAL, go short and place a protective stop above the latest price peak. The best sell signals occur when the first top is above the upper reference line and the second is below. Overbought and oversold. When stochastic rallies above its upper reference line, it shows that the market is overbought. Overbought means too high, ready to turn down. When stochastic falls below its lower reference line, it shows that the market is oversold. Oversold means too low, ready to turn up. These signals work fine during trading ranges, but not when a market develops a trend. In uptrends, stochastic quickly becomes overbought and keeps giving sell signals while the market rallies. In downtrends, stochastic quickly becomes oversold and keeps giving premature buy signals. It pays to combine stochastic with a long-term trend following indicator, see section 43. The triple screen trading system allows traders to take buy signals from daily stochastic only when the weekly trend is up. When the weekly trend is down, it allows traders to take only sell signals from daily stochastic. 3. When you identify an uptrend on a weekly chart, wait for daily stochastic lines to decline below their lower reference line. Then, without waiting for the crossover or an upturn, place a buy order above the high of the latest price bar. Once you're long, place a protective stop below the low of the trade day or the previous day, whichever is lower. The shape of stochastic's bottom often indicates whether a rally is likely to be strong or weak. If the bottom is narrow and shallow, it shows that bears are weak and the rally is likely to be strong. If it is deep and wide, it shows that bears are strong and the rally is likely to be weak. It is better to take only strong buy signals. 4. When you identify a downtrend on a weekly chart, wait for daily stochastic lines to rally above their upper reference line. Then, without waiting for their crossover or a downturn, place an order to sell short below the low of the latest price bar. By the time stochastic lines crossover, the market is often in a free fall. Once you're short, place 30, stochastic 161, a protective stop above the high of the trade day or the previous day, whichever is higher. The shape of stochastic's top often indicates whether a decline is likely to be steep or sluggish. A narrow top in stochastic shows that bulls are weak. and a severe decline is likely. A stochastic top that is high and wide shows that bulls are strong. It is safer to pass up that sell signal. 5. Do not buy when stochastic is overbought and do not sell short when it is oversold. This rule filters out most bad trades. Line direction. When both stochastic lines are headed in the same direction, they confirm the short-term trend. When prices rise and both stochastic lines rise, the uptrend is likely to continue. When prices slide and both stochastic lines fall, the short-term downtrend is likely to continue. More on stochastic. Stochastic can be used in any time frame, including weekly, daily, or intra-day. Weekly stochastic usually changes its direction 1 week prior to weekly MACD histogram. If weekly stochastic turns, it warns you that trend-following MACD histogram is likely to turn the next week. It is a SIG, an AL to tighten stops on existing positions or start taking profits. Choosing the width of the stochastic window is important. Short-term oscillators are more sensitive. Long-term oscillators turn only at important tops and bottoms. If you use stochastic as a standalone oscillator, a longer stochastic is preferable. If you use stochastic as part of a trading system, combined with trend-following indicators, then a shorter stochastic is preferable. An ingenious way to use stochastic, popularized by Jacob Bernstein, is called a stochastic pop. When stochastic crosses above its upper reference line, it indicates strength. You can buy for a quick rally and sell as soon as stochastic turns down. This signal can help you catch the last splash of the bullish wave. Stochastic is one of the favorite tools of automatic trading systems developers. These modern-day alchemists try to use stochastic in a PU.OLI 162 computerized technical analysis mechanical manner, buying and selling when the two stochastic lines cross. They discard stochastic when it fails to deliver magic results. Trading the crossovers of stochastic lines is not profitable, no matter how much you optimize them, because stochastic works differently depending on whether the market is in a trend or in a trading range. 31. Relative Strength Index. Relative Strength Index, RSI, is an oscillator developed by J. Wells Wilder, Jr. It is now included in most software packages. RSI measures the strength of any trading vehicle by monitoring changes in its closing prices. It is a leading or a coincident indicator. It is never a laggard. 100. RSI equals 100. 1 plus RS. Average of net up closing changes for a selected number of days. RS equals average of net down closing changes for the same number of days. The pattern of RSI peaks and valleys does not change in response to the width of its time window. Trading signals become more visible with shorter RSI, such as 7 or 9 days. Most traders use computers to calculate and plot RSI. Take these steps to calculate a 7-day RSI for any market. 1. Obtain closing prices for the past 7 days. 2. Find all days where the market closed higher than the day before and add up the amounts of increases. Divide the sum by 7 to obtain the average up closing change. 3. Find all days when the market closed lower than the day before and add up the amounts of declines. Divide the sum by 7 to obtain the average down closing change. 4. Divide the average up closing change by the average down closing change to obtain relative strength, RS. Insert RS in the formula above to arrive at RSI, Relative Strength Index. 5. Repeat the process daily. See worksheet, figure 31.1. 31. Relative Strength Index 163. Swiss franc. Date close UDAVC. 7-1 down average. 7 RSI. 7. October 29th, 77.34. October 30th, 78.02. October 31st, 77.71. November 1st, 78.45. 11 has 79.15. November 5th, 79.91. November 6th, 79.63. 11 sevenths 79.990.462910.0843184184.60. November 8th 79.96. 11 ninths 79.94. 11 douzième 79.96 0.2943 1 0.0587 J 83.38. November 13th 79.76 0.252310.0789 176.18. 11 14ths 80.09 0.2634 0.06 76 79.58. November 15th 79.72 0.2258 10.1 108 67.08. November 16th 180.10 0.2478. 0.09501 72.29. Figure 31 1. 7-day Relative Strength Index Worksheet. Begin by calculating average up closing and average down closing for the past 7 days. Insert the results in the RSI formula and then start using the calculation shortcut as outlined in the text. If you calculate RSI by hand, you can use a shortcut. Once you have 7 days worth of data, replace steps 2 and 3 on all following days. 2. Multiply yesterday's average up closing change by 6. Add today's up closing change, if any, and divide the total by 7. That is your new average up closing change. 3. Multiply yesterday's average down closing change by 6. Add today's down close, if any, and divide the total by 7. That is your new age down closing change. Then proceed to step 4, opposite page. RSI fluctuates between 0 and 100. When RSI reaches a peak and turns down, it identifies a top. When RSI falls and then turns up, it identifies a bottom. These turns come at different levels in different markets, or even in the same market during bull and bear periods. 164 Computerized technical analysis. Overbought and oversold levels vary from market to market and from year to year. There are no magical levels marking all tops and bottoms. Oversold and overbought signals are like hot and cold readings on a thermometer. The same temperature has a different meaning in summer or in winter. Horizontal reference lines must cut across the highest peaks and the lowest valleys of RSI. They are often drawn at 30 and 70. Some traders use 40 and 80 levels in bull markets or 20 and 60 in bear markets. Use the 5% rule. Draw each line at a level beyond which RSI has spent less than 5% of its time in the past 4 to 6 months. Adjust reference lines once every 3 months. Mass psychology. Each price represents the consensus of value of all market participants at the moment a transaction. Closing price reflects the most important consensus of the day because the settlement of traders' accounts depends on it. When the market closes higher, bulls make money and bears lose. When the market closes lower, bears make money and bulls lose. Most traders in all markets pay more attention to closing prices than to any other prices. In the futures markets, money is transferred from losers to winners' accounts at the end of each trading day. RSI shows whether bulls or bears are stronger at closing time, the crucial money counting time in the market. Trading rules. RSI gives 3 types of trading signals. They are, in order of importance, divergences, charting patterns, and the level of RSI. Bullish and bearish divergences. Divergences between RSI and prices give the strongest buy and sell signals. They tend to occur at major tops and bottoms. They show when the trend is weak and ready to reverse. Figure 31, 2. 1. Bullish divergences give by signals. They occur when prices fall to a 31. Relative Strength Index 165. 69.72. IS Ton 2A Bug, SEP 5 CF. Figure 31.2. 7-day Relative Strength Index. RSI gives its best trading signals when it diverges from prices. Its strongest divergences are those in which prices rise to a new high or fall to a new low, while RSI fails to cross its reference line. RSI tends to break its trend lines ahead of prices. In addition to the ones marked, you can find several other examples on this chart where the breaking of RSI trend lines identifies turning points in the Swiss franc. At the right edge of the chart, as soon as RSI breaks above its trend line, it will confirm a bullish divergence and give a strong buy signal. New low, but RSI makes a more shallow bottom than during its previ. Us decline. Buy as soon as RSI turns up from its second bottom, and place a protective stop below the latest minor price low. Buy signals are especially strong if the first RSI bottom is below its lower reference line and the second bottom is above that line. 2. Bearish divergences give sell signals. They occur when prices rally to a new peak, but RSI makes a lower top than during the previous rally. Sell short as soon as RSI turns down from its second top, and place a protective stop above the latest minor high. Sell signals are especially strong if the first RSI top is above its upper reference line and the SEC on top is below it. 166. Computerized technical analysis. Charting patterns. Classical charting methods work better with relative strength index than with other indicators. Trend lines, support and resistance, and head and shoulders patterns work well with RSI. RSI often completes these patterns a few days in advance of prices, providing hints of likely trend changes. 4. Example, RSI trend lines are usually broken 1 or 2 days before price. Trend lines. 3. When RSI breaks its downtrend line, place an order to buy above the price trend line in order to catch an upside breakout. 4. When RSI breaks its uptrend line, place an order to sell short below the price trend line to catch a downside breakout. RSI levels. When RSI rises above its upper reference line, it shows that bulls are strong, but the market is overbought and entering its sell zone. When RSI declines below its lower reference line, it shows that bears are strong, but the market is oversold and entering its buy zone. It pays to buy using overbought signals of daily RSI only when the weekly trend is up. It pays to sell short using sell signals of daily RSI only when the weekly trend is down. See section 43. 5. Buy when RSI declines below its lower reference line and then rallies above it. 6. Sell short when RSI rises above its upper reference line and then crosses below it. More on RSI. Some traders try to find deeper meaning in RSI patterns. Some analysts have described formations called positive and negative reversals, which they said forecasted the extent of any price move using RSI patterns. So far, there have been no reports of conspicuous success using these patterns from anyone but their promoters. The neglected essentials. 32. Volume. Volume represents the activity of traders and investors. Each unit of volume in a market reflects the action of two persons. One trader sells a share and another buys a share, or one buys a contract and another sells a contract. Daily volume is the number of contracts or shares traded in one day. Traders usually plot volume as a histogram, vertical bars whose height reflects each day's volume, figure 32.1. They usually draw it underneath prices. Changes in volume show how bulls and bears react to price swings. Changes in volume provide clues as to whether trends are likely to continue or to reverse. Some traders ignore volume. They think that prices already reflect all information known to the market. They say, you get paid on price and not on volume. Professionals, on the other hand, know that analyzing volume can help them understand markets deeper and trade better. There are 3 ways to measure volume. 1. The actual number of shares or contracts traded. For example, the New York Stock Exchange reports volume this way. This is the most objective way of measuring volume. 2. the number of trades that took place. For example, the London Stock Exchange reports volume this way. This method is less objective because it does not distinguish between a 100-share trade and a 5,000-share trade. 167. 168. The neglected essentials. Figure 32.1. Volume. To interpret volume, you need to link changes with changes in prices. A. An increase in volume during an uptrend calls for higher prices. Ahead, buy, or add to longs. B. Prices jump on more than double the average volume. It is a sign of a potential blow-off move/fight and stops on long positions. C. Prices rally near the level of their previous peak, but volume is much lower. This bearish divergence signals a topper ET tongs and go short. D. P. Prices collapse underscore on panicky volume. Such climax bottoms are USU. Ally retested FJ, Iton stews on short positions. E. Silver falls to a new low, but volume is lower than it was at point. D. A typical retest of a climax bottom cover shorts and go long and I. F. A new high in price is accompanied by an increase in volume. Sim. Eiler to what happened at point A. Continue to hold long positions. 3. Tick volume is the number of price changes during a selected time, such as 10 minutes or an hour. It is called tick volume because most changes equal 1 tick. Most futures exchanges in the United States do not report intraday volume, and day traders use tick volume as its proxy. 32. Volume. 169. Volume reflects the activity of buyers and sellers. If you compare volume between two markets, it will show which one is more active or liquid. You are likely to suffer less slippage in liquid markets than in thin, low-volume markets. Crowd psychology. Volume reflects the degree of financial and emotional involvement, as well as pain of market participants. A trade begins with a financial commitment by two persons. The decision to buy or sell may be rational, but the act of buying or selling creates an emotional commitment in most people. Buyers and sellers crave to be right. They scream at the market, pray, or use lucky talismans. Volume reflects the degree of emotional involvement among traders. Each tick takes money away from losers and gives it to winners. When prices rise, longs make money and shorts lose. When prices fall, shorts gain and longs lose. Winners feel happy and elated, while losers feel depressed and angry. Whenever prices move, about half the traders are hurting. When prices rise, bears are in pain, and when prices fall, bulls suffer. The greater the increase in volume, the more pain in the market. Traders react to losses like frogs to hot water. If you throw a frog into a boiling kettle, it will jump in response to sudden pain. But if you put a frog into cool water and heat it slowly, you can boil it alive. If a sudden price change hits traders, they jump from pain and liquidate losing positions. The same losers can be very patient if their losses increase gradually. You can lose a great deal of money in a sleepy market, such as COM, where a 1-cent move costs only $50. If COM goes against you just a few cents a day, the pain is easy to tolerate. If you hang on, those pennies can add up to thousands of dollars in losses. Sharp moves, on the other hand, make losers cut their losses in a panic. Once weak hands get shaken out, the market is ready to reverse. Trends can last for a long time on moderate volume, but can expire after a burst of volume. Who buys from a trader who sells is losing long position. It may be a short seller taking profits and covering shorts. It may be a bargain hunter who steps in because prices are too low. That bottom picker assumes the position of a loser who washed out, and he either catches the bottom or becomes the new loser, who sells to a trader who buys to cover his losing short position. It may 170. The neglected essentials. Be a savvy investor who takes profits on his long position. It also may be a top picker who sells short because he thinks that prices are too high. He assumes the position of a loser who covered his shorts and only the future will tell whether he is right or wrong. When shorts give up during a rally, they buy to cover and push the market higher. Prices rise, flush out even more shorts, and the rally feeds on itself. When longs give up during a decline, they sell and push the market lower. Falling prices flush out even more longs, and the decline feeds on itself. Losers who give up propel trends. A trend that moves on steady volume is likely to continue. Steady volume shows that new losers replace those who wash out. Trends need a fresh supply of losers the way builders of the ancient pyramids needed a fresh supply of slaves. Falling volume shows that the supply of losers is running low and a trend is ready to reverse. It happens after enough losers catch on to how wrong they are. Old losers keep bailing out, but fewer new losers come in. Falling volume gives a sign that the trend is about to reverse. A burst of extremely high volume also gives a signal that a trend is nearing its end. It shows that masses of losers are bailing out. You can probably recall holding a losing trade longer than you should have. Once the pain becomes intolerable and you get out, the trend reverses and the market goes the way you expected, but without you. This happens time and again because most AMA tours react to stress similarly and bail out at about the same time. Professionals do not hang in while the market beats them up. They close out losing trades fast and reverse or wait on the sidelines, ready to re-enter. Volume usually stays low in trading ranges because there is relatively little pain. People feel comfortable with small price changes and trendless. Markets seem to drag on forever. A breakout is often marked by a dramatic increase in volume because losers run for the exits. A breakout on low vol UME shows little emotional commitment to a new trend. It indicates that prices are likely to return into their trading range. Rising volume during a rally shows that more buyers and short sellers are pouring in. Buyers are eager to buy even if they have to pay up, and shorts are eager to sell to them. Rising volume shows that losers who leave are being replaced by a new crop of losers. When volume shrinks during a rally, it shows that bulls are becoming less eager, while bears are no longer running for cover. The intelligent bears have left long ago, followed by weak bears who could not take the pain. Falling volume shows that fuel is being removed from the uptrend and it is ready to reverse. 32. Volume 171. When volume dries up during a decline, it shows that bears are less eager to sell short, while bulls are no longer running for the exits. Be intelligent. Bulls have sold long ago, and the weak bulls have been shaken out. Falling volume shows that the remaining bulls have a higher level of pain tolerance. Perhaps they have deeper pockets, or bought later in the decline, or bought. Falling volume identifies an area in which a downtrend is likely to reverse. This reasoning applies to long and short time frames. As a rule of thumb, it shows that bulls are no longer running or that selling pressure is spent. When volume dries up, it shows that the reaction is nearing an end and the uptrend is ready to resume. This identifies a good buying opportunity. Major downtrends are often punctuated by rallies which begin on heavy vol. 172. The neglected essentials. UME. Once weak bears have been flushed out, volume shrinks and give a signal to sell short. More on volume. You can use a moving average to define the trend of volume. The slope of a 5-day exponential moving average of volume can define volume's trend. You can also draw trend lines of volume and watch for their breakouts. See Section 21. Volume breakouts confirm price breakouts. Volume-based indicators provide more precise timing signals than volume alone. Traders Index, Herrick Payoff Index, Force Index, and others include volume data. See Chapters 6 and 8. 33. Volume-based indicators. Traders can use several technical indicators to help them analyze volume. Some traders track a 5-day exponential moving average of volume. Its slope identifies the trend of volume. See sections 25 and 32. Others use on balance volume and accumulation/distribution. On balance volume. On balance volume, OBEV, is an indicator designed by Joseph Granville and described in his book, New Strategy of Daily Stock Market Timing. Granville used OBEV as a leading indicator of the stock market, but other analysts have applied it to the futures markets. OBEV is a running total of volume. It rises or falls each day depending on whether prices close higher or lower than on the previous day. When a stock closes higher, it shows that bulls won the day's battle. Its volume on that day is added to OBEV. When a stock closes lower, it shows that bears won the day, and that day's volume is subtracted from OBEV. If prices close unchanged, OBEV stays unchanged. On balance volume often rises or falls before prices. It acts as a leading indicator. As Granville put it, volume is the steam that makes the chew go. 33. Volume-based indicators 173. Crowd psychology. Prices represent the consensus of value, while volume represents the emo tie-ins of market participants. It reflects the intensity of traders' financial and emotional commitments, as well as pain among losers. See section 32. OBEV is a running total of volume. It tracks changes in traders' involvement in a market and the intensity of their pain. A new high in OBEV shows that bulls are powerful, bears are hurting, and prices are likely to rise. A new low in OBEV shows that bears are powerful, bulls are hurting, and prices are likely to fall. When the pattern of OBEV devi Atesh from the pattern of prices, it shows that mass emotions are not in gear. With mass consensus, a crowd is more likely to follow its heart than its mind. This is why changes in volume often precede changes in prices. Trading signals. The patterns of OBEV tops and bottoms are more important than the absolute levels of this indicator. Those levels depend on when you start to calculate. On balance volume. When OBEV rises or falls together with prices, the trend is confirmed. If prices reach a new high and OBEV reaches a new high, the uptrend is likely to continue. If prices reach a new low and OBEV falls to a new low, the downtrend is likely to continue. It is safer to trade in the direct tie-in of a trend that is confirmed by OBEV, figure 33, 1. When OBEV reaches a new high, it confirms the power of bulls. Indicates that prices are likely to rise even higher and give a buy signal. When OBEV reaches a new low, it confirms the power of bears calls for lower prices ahead and gives a signal to sell short. 2 OBEV gives its strongest buy and sell signals when it diverges from Vristelphi, S rally, sell off, and then rise to a new high, but OBEV rallies to a lower high. It creates a bearish divergence and gives a strong sell signal. If prices decline, rebound, and then fall to a new low, but OBEV falls to a more shallow bottom, it traces a bullish divergence and gives a strong buy signal. Long-term divergences are more important than short-term divergences. Divergences that develop over the course of several weeks give stronger signals than those that last only a few days. 174. The neglected essentials. 73. 5. 56. 48. 48. 658,587. 534,736. 418,964. 287,193. 163,421. Figure 33, 1. On balance volume. When OBEV moves in gear with a trading vehicle, it confirms its trend. The uptrend A of OBEV confirms the stock rally. Its break in March gives a sell signal. There are 2 shorting signals at the top. The first in early April is given by a bearish divergence between OBEV and price. 2 weeks later, OBEV breaks its support B, giving another signal to sell short. The downtrend line C of OBEV confirms the slide of Apple. Computer holds shorts. An upside breakout in July gives a signal to cover shorts. 3 When prices are in a trading range and OBV breaks out to a new high, it gives a buy signal. When prices are in a trading range and OBV breaks down and falls to a new low, it gives a signal to sell short. More on OBV. One of the reasons for Granville's success in his heyday, see Section 6, was that he combined OBV with two other indicators, the net field trend indicator and the climax indicator. Granville calculated OBV for each stock in the Dow Jones Industrial Average and rated its OBV pattern as risk, ING, falling, or neutral. He called that a net field trend of a stock. It could 33. Volume-based indicators 175. B plus 1, minus 1, or 0. Climax indicator was a sum of the net field trends of all 30. Dow stocks. When the stock market rallied and the climax indicator reached a new high, it confirmed strength and gave a buy signal. If the stock market rallied, but the climax indicator made a lower top, it gave a sell signal. You can view the Dow Jones Industrial Average as a team of 30 horses pulling the market wagon. The climax indicator shows how many horses are pulling uphill, downhill, or standing still. If 24 out of 30 horses pull up one, down, and 5 are resting, then the market wagon is likely to move up. If 9 horses pull up, 7 pull down, and 14 are resting, then the wagon is ready to roll downhill. OBV, the net field trend indicator, and the climax indicator can be highly programmed on a computer. It would be worthwhile to apply them to a database which includes all stocks of the S&P 500 index that may produce good signals for trading S&P 500 futures or options. Accumulation/distribution. This indicator was developed by Larry Williams and described in his 1972 book, How I Made $1 Million. It was designed as a leading indicator for stocks, but several analysts have applied it to futures. The unique feature of accumulation/distribution, A/D, is that it tracks the relationship between opening and closing prices along with volume. If prices close higher than they opened, then bulls won the day and A/D is positive. If prices close lower than they opened, then the bears won and A/D is negative. If prices close where they opened, then nobody won and A/D is 0. A running total of each day's A/D creates a cumulative accumulation/distribution indicator. A/D credits bulls or bears with only a fraction of each day's volume. That fraction depends on the day's range and the distance from opening to closing price. The greater the spread between opening and closing price relative to daily range, the greater phi caret hang tht caret accumulatin/distribution. Close open. A/D of volume. High-low. For example, if the distance from today's high to low is 5 points, but the distance from the open to the close is 2 points, then only 2/5 of today's volume, 1/76, the neglected essentials, is credited to the winning camp. The pattern of A/D highs and lows is more important than its absolute level, which depends on the starting date. When the market rises, most people focus on new highs. But if prices open higher and close lower, then A/D, which tracks their relationship, turns down. It warns that the uptrend is weaker than it appears. If A/D ticks up while prices are down, it shows that bulls are gaining strength. Crowd behavior. Opening and closing prices are among the most important prices of the day. The opening price reflects all the pressures that have gathered while the market was closed. Openings are often dominated by amateurs who read their newspapers in the evening and trade in the morning. Professional traders are active throughout the day. They often trade against the amateurs. As the day goes on, waves of buying and selling by amateurs and slow-moving institutions gradually subside. Professionals USU ally dominate the markets at closing time. Closing prices are especially important because the settlement of trading accounts depends on them. A/D tracks the outcomes of daily battles between amateurs and profs. Signals. It ticks up when prices close higher than they opened. When professionals are more bullish than amateurs. It ticks down when prices close lower than they opened. When professionals are more bearish than AMA. Duh. It pays to bet with the professionals and against the amateurs. Trading rules. When a market opens low and closes high, it moves from weakness to strength. A/D then rises and shows that market professionals are more bullish than amateurs. This means that the market is likely to move higher. The following day, when A/D falls, it shows that market professionals are more bearish than amateurs. When the market moves from strength to weakness, it is likely to reach a lower low the following day. The best trading signals are given by divergences between A/D and prices. 1. If prices rally to a new high, but A/D reaches a lower peak, it gives a signal to sell short. This bearish divergence shows that market professionals are selling into the rally. Figure 33.2. 33. Volume-based indicators 177. 2. A bullish divergence occurs when prices fall to a new low, but A/D stops at a higher low than during its previous decline. It shows that market professionals are using the decline for buying and a rally is coming. More on accumulation/distribution. When you go long or short, following a divergence between A/D and price, remember that even market professionals can go wrong. You stops and protect yourself by following the hound of the Baskervilles rule. See section 23. Volume accumulator, designed by Mark Chaikin, is an indicator very similar to A/D. Volume accumulator uses a mean price for the day instead of the opening price. It is especially useful for those analysts who do not have 178 the neglected essentials access to opening prices. Its trading signals and rules are similar to accumulation/distribution. There are important parallels between A/D and Japanese candlestick charts. Both focus on the differences between opening and closing prices. A/D goes further than candlesticks by taking volume into account. 34. Open interest. Open interest is the number of contracts held by buyers or owed by short sellers in a given market on a given day. It shows the number of existing contracts. Open interest equals either a total long or a total short position. Stock market shares are traded for as long as a company stays in business. As a separate unit, futures and options traders, on the other hand, deal in contracts for future delivery that expire at a set time. A futures or options buyer who wants to accept delivery and a seller who wants to deliver have to wait until the first notice day. This waiting period ensures that the numbers of contracts that are long and short are always equal. In any case, very few futures and options traders plan to deliver or to accept delivery. Most traders close out their positions before the first notice day. Open interest rises or falls depending on whether new traders enter the market or old traders exit it. Open interest rises only when a new buyer and a new seller enter the market. Their trade creates a new contract. For example, if open interest in April COMEX Gold is 8,500 contracts, then 8,500 contracts are held by bulls and 8,500 contracts are owed by short sellers at the close of that day. If open interest rises to 8,600, it means that the net of 100 new contracts have been bought and sold short. Open interest falls when a trader who is long trades with someone who is short. When both of them close out their positions, open interest falls by one contract because one contract disappears. If a new bull buys from an old bull who is getting out of his long position, open interest remains unchanged. Open interest also does not change when a new bear sells to an old bear who needs to buy because he is closing out his short position. Buyer-seller open interest. New buyer, new seller increases. New buyer, former buyer sells, unchanged. Former seller buys to cover new seller, unchanged. Former seller buys to cover former buyer, sells, decreases. 34. Open interest 179. Most futures and options exchanges release open interest data one day, later than prices. Some exchanges provide phone numbers to call for preliminary figures on open interest. Technicians usually plot open interest as a line below price bars figure 34 to 1. Some chart services also plot average open interest for the past several years. Open interest gives important messages when it deviates from its seasonal norm. Open interest varies from season to season in many markets because of massive hedging by commercial interests at different stages in production cycles. Open interest in currency futures tends to drop 4 times a year at the time of a contract rollover. If open interest does not drop during a rollover, it shows a strong commitment among traders to the existing trend, which is likely to accelerate. Crowd psychology. It takes one bull and one bear to create a futures or options contract. A bull buys a contract if he is convinced that prices are going higher. A bear sells short a contract if he is convinced that prices are going lower. When the two trade, open interest rises by one contract. A single trade between one bull and one bear is unlikely to move the markets. But when thousands of traders make their trades, they propel or reverse market trends. Open interest reflects the intensity of conflict between bulls and bears. It reflects the willingness of longs to maintain long positions and the willingness of shorts to maintain short positions. When bulls and bears do not expect the market to move in their favor, they close out their positions and open interest shrinks. There are two people on opposite sides of every trade. One of them gets hurt when prices change. If prices rally, bears get hurt. If prices fall, bulls get hurt. As long as the losers hope, they hang on, and open interest does not change. A rise in open interest shows that a crowd of confident bulls is facing down a crowd of equally confident bears. It points to a growing disagreement between the two camps. One group is sure to lose, but as long as potent tile losers keep pouring in, the trend will continue. These ideas have been clearly put forth in L. D. Belleville's classic book, Charting Commodity Market Price Behavior. Bulls and bears keep adding to their positions as long as they strongly dis. 180. The neglected essentials. Figure 34.1. Open interest. Open interest, OL, reflects the number of all short or long positions in any futures or options market. Open interest depends on the intensity of conflict between bulls and bears. Rising OL shows that the conflict between bulls and bears is becoming more intense and confirms the existing trend. Rising OL during uptrends shows it is safe to add to long positions, A and D. Flat OL shows that fewer losers are entering the market. This means that a mature trend is nearing its end, and it is time to take profits or tighten stops, B and E. Falling OL shows that losers are leaving the market and winners are cash. ING in that a trend is nearing its end. A fire cannot continue when fuel is withdrawn, and a sharp drop in OL during a trend signals that a reversal is near, C and F. At the right edge of the chart, cocoa prices have stabilized after falling. In October, an open interest is flat. It shows that the decline in cocoa has shaken out weak bulls and the uptrend is ready to resume. It is time to go long, with a protective stop below the recent lows. Agree about the future course of prices. It takes conviction and disagreement to maintain a trend. Rising open interest shows that the supply of losers is growing and the current trend is likely to persist. If open interest increases during an uptrend, it shows that longs are buying while bears are shorting. 34. Open interest 181. Because they believe that the market is too high, they are likely to run for cover when the uptrend puts a squeeze on them, and their buying will propel prices higher. If open interest rises during a downtrend, it shows that shorts are aggressively selling while bottom pickers are buying. Those bargain hunters are likely to bail out when falling prices hurt them, and their selling will push prices even lower. An increase in open interest gives a green light to the existing trend. When a bull is convinced that prices are going higher and decides to buy, but a bear is afraid to sell short, that bull can buy only from another bull who bought earlier and now wants to get out. Their trade creates no new contract, and open interest stays unchanged. When open interest stays flat during a rally, it shows that the supply of losers has stopped growing. When a bear is convinced that prices are going lower, he wants to sell short. If a bull is afraid to buy from him, that bear can only sell to another bear who shorted earlier and now wants to cover and leave. Their trade CRE. Atesh no new contract, and open interest does not change. When open interest stays flat during a decline, it shows that the supply of bottom pickers is not growing. Whenever open interest flattens out, it flashes a yellow light, warning that the trend is aging and the best gains are probably behind. Falling open interest shows that losers are bailing out while winners are taking profits. When their disagreement decreases, the trend is ripe for a reversal. Open interest falls when losers abandon hope and get out of the market without being replaced by new losers. When a bull decides to get out of his long position and a bear decides to cover his short position, the two may trade with one another. When they do, a contract disappears and open interest shrinks by one contract. Falling open interest shows that winners are cashing in and losers are giving up hope. It flashes a red light. It signals the end of a trend. Trading rules. A 10% change in open interest deserves serious attention, while 25% change often gives major trading messages. The meaning of rising, falling, or flat open interest depends on whether prices are rallying, falling, or flat at the time of change in open interest. 1. When open interest rises during a rally, it confirms the uptrend and gives a signal that it is safe to add to long positions. It shows that more. 182 The neglected essentials. Short sellers are coming into the market. When they bail out there, short covering is likely to push the rally higher. 2. When open interest rises while prices fall, it shows that bottom pick heirs are active in the market. It is safe to sell short because these gain hunters are likely to push prices lower when they throw in the towel. 3. When open interest rises while prices are in a trading range, it is a bearish sign. Commercial hedgers are more likely to sell short than speculators. A sharp increase in open interest while prices are flat shows that savvy hedgers are probably shorting the market. 4. When open interest falls sharply while prices are in a trading range, it identifies short covering by major commercial interests and gives a buy signal. When commercials start covering shorts, they show that they expect the market to rise. 5. When open interest falls during a rally, it shows that both winners and losers are getting cold feet. Longs are taking their profits and shorts are covering. Markets discount the future, and a trend that is accepted by the majority is ready to reverse. If open interest falls during a rally, sell and get ready to sell short. 6. When open interest falls during a decline, it shows that shorts are COV. Airing and buyers are taking their losses and bailing out. If open interest falls during a slide, cover shorts and get ready to buy. 7. When open interest goes flat during a rally, it warns that the uptrend is getting old and the best gains have already been made. This gives you a signal to tighten stops on long positions and avoid new buying. When open interest goes flat during a decline, it warns you that the downtrend is mature and it is best to tighten stops on short positions. Flat open interest in a trading range does not contribute any new info. Matt Ion. More on open interest. The higher the open interest, the more active the market and the less slip paid you risk while getting in and out of positions. Short-term traders should focus on the markets with the highest open interest. In the futures markets, it pays to trade the delivery months with the highest open interest. 35. Herrick Payoff Index 183. Tracking commitments of traders' reports can help you find out whether new buying or selling is primarily done by small or large specula. tours, or by hedgers. See Chapter 7. Very few technical indicators use open interest. The Herrick Payoff Index is the best-known indicator that utilizes it. 35. Herrick Payoff Index. The Herrick Payoff Index, HPI, is an indicator developed by John Herrick, a technical market analyst from California. He taught it privately, but the indicator became more popular after it was included in CompuTrack software in the early 1980s. The Herrick Payoff Index helps detect accumulation and distribution. Most indicators measure only prices, some measure volume, but HPI tracks open interest as well as prices and volume. HPI confirms valid trends and helps catch their reversals. How to construct HPI. The Herrick Payoff Index may be calculated using several types of daily data. You may use a single contract with its own price, volume, and open interest. It is more practical to combine volume and open interest from all contracts and apply them to the prices of the most active delivery month. HPI uses daily high and low prices, volume, and open interest. It requires data for at least 3 weeks before it begins producing meaningful numbers. Its complex formula makes using a computer almost a necessity. See work sheet, figure 35-1. Herpt Gooch G. Where chi equals yesterday's HPI. K equals /y, see, 1 plus or minus /2 / G. And M equals mean price, i.e., high plus low, /2. My equals yesterday's mean price. C equals the value of a 1-cent move, or use the same constant for all contracts. V equals volume. 184 the neglected essentials. Copper. Date I high low close volume 01 mean J HPI. 12/27, 106.80, 104.58, 104.65, 4,552, 105.69 / 12/28, I 105.19, 104.11, 3,208 SCB, 104.65 J. December 29th. 105, 104, 4,400 og 720 og 9,980 og 705, 0420 og 90. MLTUY 100, 3.60, 104.97, 4,000, 146, 30,000, 249, 104.38, minus 28.8. January 3rd. 108.1705.61, 108.029 1940, 30 928 J-J6.3. 1/04, I 109.09, 105.96, 10,036, 28,944, 107.52 J6.3. 1/05, I 107.97, 107.03, IOX 4,260, 29,015, 107.50, I 5.5. 1/08, I 109.46, 108.6, 109.15, 8,030, 30,000, 125, 108.74, J 15.6. 1/091 lid. 00, 108.00, 108.0, 5, 6,000, 107, 30,000, 162 millimeters, 15.7. 10分の1 I108.6605.8606 165,840 129,914 Mu 2.3. January 11th. 107.4106.7 173,33 9,990,696.96 I 2.2. 1/12, I 105.77, 103.7, 9,053, 30,000, 850, 104.74, J minus 17.1. Figure 35-1. Herrick Payoff Index Worksheet. HPI measures changes in prices, volume, and open interest. It is based on mean rather than closing prices the average consensus of value for the day. The complexity of HPI makes using a computer almost a necessity. I equals absolute value of today's minus yesterday's open interest. G equals today's or yesterday's open interest, whichever is less. The plus or sign in the right brackets is determined as follows. If M, my, the sign is if M, my, the sign is. Traders can apply HPI only to daily data and not to weekly or intraday data. There is no such thing as weekly open interest. Weekly volume can be obtained by adding up daily volume for 5 days, but open interest cannot be added up. Crowd psychology. The Herrick Payoff Index measures mean prices rather than closing prices. Daily mean prices represent the average consensus of value for the day. Volume represents the degree of financial commitment in a given market. When volume increases, the absolute value of HPI for that day increases. 35. Herrick Payoff Index 185. Daily changes in open interest represent the flow of funds into and out of the market. Rising open interest is bullish in an uptrend and bearish in a downtrend. Falling open interest is bearish in an uptrend and bullish in a downtrend. Flat open interest is essentially neutral. Trading rules. The Herrick Payoff Index gives several types of trading signals, listed here, in the order of importance. Divergences between HPI and prices identify some of the best trading opportunities, figure 35-2. When HPI breaks its trend line, it gives an early warning that a price trend line is likely to be broken. When HPI crosses its center line, it confirms new price trends. 1. When prices fall to a new low, but HPI makes a higher bottom than during the previous decline, it creates a bullish divergence and gives a buy signal. When HPI turns up from its second bottom, buy in place. A protective stop below the latest price low. 2. A bearish divergence occurs when prices rally to a new high, but HPI makes a lower top. The signal to sell short is flashed when HPI turns down from its second top. Place a protective stop above the latest high price. Important divergences develop over the course of several weeks. A divergence that takes 2 months to develop is more powerful than the one in which 2 weeks pass between the tops or bottoms. Pay attention to the differences in the height of the adjacent HPI tops or bottoms. If the first top or bottom is far away from the center line and the second top or bottom is near that line, that divergence is likely to lead to a greater move. Bullish and bearish divergences of HPI often have long lead times. Once you have identified a potential turning point using an HPI divergence, lean on short-term oscillators for more precise timing. If a divergence between HPI and price aborts and you get stopped out, watch closely. You may get an even better trading opportunity if a regular divergence turns into a triple bullish or triple bearish divergence. Triple bullish divergences consist of 3 lower bottoms in prices and 3 higher bottoms in HPI. Triple bearish divergences consist of 3 higher tops in prices and 3 lower tops in HPI. They occur at some of the major turning points in the markets. 3. HPI lends itself well to classical charting methods, especially trend lines. When trend lines of prices and HPI point in the same direction. 186. The neglected essentials. Figure 35-2. Herrick Payoff Index. HPI tracks the flow of funds into or out of the market by measuring changes in prices, volume, and open interest. HPI gives its best signals when its patterns diverge from price patterns. HPI identified market tops in August and September by tracing lower peaks while prices rose to new highs. HPI called market bottoms in October and November when it stopped declining and bottomed out at more shallow levels while copper slid to new lows. The bullish divergence in November was followed by a breaking of a downtrend line of HPI and a rally above HPI's centerline. This culminated Tying gave an especially strong signal to buy copper. The best signals develop slowly and give traders plenty of time to get aboard a new trend. They confirm trends. HPI often breaks its trend line before prices break theirs. When HPI breaks below its uptrend, it gives a sell signal. When it breaks above a downtrend, it gives a buy signal. Then it pays to either take profits or to tighten stops. For the position of HPI above or below its center line shows whether bulls or bears dominate the market. When HPI is above its center line, it shows that bulls are in control. It is better to be long. When HPI is below its center line, it is better to be short. Bulls may buy or add to 36 time 187. They're long positions when HPI rises above its center line. When HPI declines below its center line, it confirms downtrends. 36 time. Most people conduct their lives as if they intend to live forever, with no review of the past, no real planning for the future, and minimal learning from past mistakes. Freud showed that the unconscious mind does not have a notion of time. Our deep-seated wishes remain largely unchanged throughout life. When people join crowds, their behavior becomes even more primitive and impulsive than when they are alone. Crowds pay no attention to time, even though they are affected by its passage. Individuals are ruled by the cow, Indar, and the clock, but crowds have no notion of time. Crowds act out their emotions as if they had all the time in the world. Most traders focus only on changes in prices and pay little attention to time. This is just another sign of being caught up in mass mentality. The awareness of time is a sign of civilization. A thinking person is aware of time, while someone who is acting impulsively is not. A market analyst who pays attention to time is aware of a dimension hidden from the market. Crowd cycles. Long-term price cycles are a fact of economic life. For example, the U.S. stock market tends to run in 4-year cycles. They exist because the ruling party inflates the economy going into the presidential election once every 4 years. The party that wins the election deflates the economy when VOT. Heirs cannot take revenge at the polls. Flooding the economy with liquidity lifts the stock market, and draining liquidity pushes it down. This is why the 2 years before a presidential election tend to be bullish, and the first 12 to 18 months following an election tend to be bearish. Major cycles in agricultural commodities are due to fundamental product tie-in factors coupled with the mass psychology of producers. For example, when livestock prices rise, farmers breed more animals. When those animals reach the market, prices fall and producers cut back. When the supply is absorbed, scarcity pushes prices up, breeders go to work again, and 188, the neglected essentials. Bull/bear cycle repeats. This cycle is shorter in hogs than in cattle because pigs breed faster than cows. Long-term cycles can help traders identify market tides. Instead, most traders get themselves in trouble by trying to use short-term cycles for sound timing and predicting minor turning points. Price peaks and valleys on the charts often seem to follow in an orderly manner. Traders reach for a pencil and a ruler, measure distances between neighboring peaks, and project them into the future to forecast the next top. Then they measure distances between recent bottoms and extend them into the future to forecast the next low. Cycles put bread and butter on the tables of several experts who sell share. Vice is forecasting highs and lows. Few of them realize that what appears like a cycle on the charts is often a figment of the imagination. If you analyze price data using a mathematically rigorous program such as John Eller's MESA, maximum entropy spectral analysis, you will see that approximately 80% of what appears like cycles is simply market noise. A human mind needs to find order in chaos, and an illusion of order is better than no order for most people. If you look at any river from the air, it appears to have cycles swinging right and left. Every river meanders in its valley because water flows faster in its middle than near the shores, creating turbulences that force the river to turn. Looking for market cycles with a ruler and a pencil is like searching for water with a divining rod. Profits from an occasional success are erased by many losses due to unsound methods. If you're serious about trading with cycles, you need a mathematical method for finding them, such as MESA or Fourier analysis. Fourier analysis searches for cycles in very large data samples, but MESA takes a different tack. It searches for evidence of orderly cyclical movement. In a relatively short data window, figure 36.1, unlike other packages, which give non-stop trading signals, MESA tells traders that no valid cycles are present about 80% of the time. It aims to recognize cycles as they emerge from market noise and tells you when a cycle begins to fade. Indicator seasons. A farmer sows in spring, harvests in late summer, and uses the fall to get ready for winter. There's a time to sow and a time to reap, a time to bet on a warm trend, and a time to get ready for a cold spell. The concept of seasons. 36, time 189. Figure 36.1. Price cycles maximum entropy spectral analysis. MESA. MESA, a method and a software package, shows that cycles are prone to shift and disappear. The narrow window at the bottom of the chart keeps track of cyclic content. When it is near its upper edge, it shows that the market is chaotic, and when it nears its lower edge, it shows that the market is cycling. A vertical arrow marks a transition from a chaotic to a cyclical market. The square window in the upper left corner shows cyclic content for any date selected by the analyst. It currently shows that a 13-day cycle is rising above the market noise. The jagged line at the right edge of the chart projects the current cycle several days into the future. Can be applied to the financial markets. A trader can use a farmer's approach. You should look to buy in spring, sell in summer, go short in the fall, and cover in winter. Martin Pring developed the model of seasons for prices, but this concept works even better with technical indicators. Indicator seasons show you where you are in the market cycle. This simple but effective concept helps. You buy when prices are low and sell short when they are high. It tells you 190 the neglected essentials. When an indicator signal is likely to be strong or weak, it helps you stand apart from the market crowd. The season of any indicator is defined by two factors, its slope and its position above or below the center line. For example, we can apply the concept of indicator seasons to MACD histogram. See section 26. We define the slope of MACD histogram as the relationship between two neighboring bars. When MACD histogram rises from below its center line, it is spring. When it rises above its center line, it is summer. When it falls from above its center line, it is autumn. And when it falls below its center line, it is winter. Spring is the best season for going long, and autumn is the best season for selling short. Figure 36.2. Indicator slope position relative to centerline season action. Rising below, spring go long. Rising above, summer, start selling. Falling above, fall go short. Falling below, winter, start covering. When MACD histogram is below its centerline, but its slope is rising, it is spring in the market. The weather is cool, but turning warmer. Most traders expect the winter to return and are afraid to buy. Emotionally, it is hard to buy because the memories of a downtrend are still fresh. In fact, spring is the best time for buying with the highest profit potential. Risk is low because a protective stop can be placed slightly below the market. When MACD rises above its centerline, it is summer in the market, and most traders recognize the uptrend. It is emotionally easy to buy in summer because bulls have plenty of company. In fact, profit potential in summer is lower than in spring, and risks are higher because stops have to be farther away from the market. When MACD histogram is above its centerline, but its slope turns down, it is autumn in the market. Few traders recognize the change, and they keep buying, expecting summer to return. Emotionally, it is hard to sell short in autumn. It requires you to stand apart from the crowd, which is still bullish. In fact, autumn is the best time for selling short. The profit potential is high, while risks can be limited by placing a stop above the recent highs or using options. When MACD histogram falls below its center line, it is winter in the market. By then, most traders recognize the downtrend. It is emotionally easy to sell short in winter, joining many vocal bears. In fact, the risk-reward ratio is rapidly shifting against bears. Potential rewards are getting smaller and risks are high because stops have to be placed relatively far away from prices. 36 time 191, 32,421, 292 1, 2 102, 22,942, 19,782, 7.10, 27.45, 4.1923, 384.83, 715.48. Figure 36 2. Indicator seasons. The concept of seasons can be applied to almost any indicator, even though this example focuses on the weekly MACD histogram. It helps you trade in gear with the markets. Autumn, the indicator is above its center line but falling. This is the best season for establishing short positions. Winter, the indicator drops below its center line. Use weakness to take profits on short positions. Spring, the indicator turns up from below its center line. It is the best time to establish long positions. Notice a cold spell in spring, when prices fell to a new low and MACD histogram ticked down temporarily. Do not sell short when MACD histogram turns down from below its center line. Do not buy when it turns up from above its center line. A bullish divergence when prices fall to a new low, while the indicator makes a more shallow bottom, gives a powerful buy signal. Summer, the indicator rises above its center line. When the weather gets hot, use strength to take profits on long positions. Just as a farmer pays attention to the vagaries of weather, a trader needs to pay attention to the vagaries of the markets. An autumn on the farm can be interrupted by an Indian summer, and a market can stage a strong rally in 192, the neglected essentials. Autumn, a sudden freeze can hit the fields in spring, and the market can drop early in a bull move. A trader needs to use his judgment and apply several indicators and techniques to avoid getting whipsawed. See section 43. The concept of indicator seasons focuses a trader's attention on the passage of time in the market. It helps you plan for the season ahead instead of jumping in response to other people's actions. Retracements. Many traders watch price retracements. For example, if a market rallies 120 points, traders try to add to long positions when the market retraces 50% of the preceding move and declines 60 points from the top. Many floor traders look for a trend to reverse after it retraces 61.8% of the previous move. This number is based on the Fibonacci number series. This idea of measuring retracements can also be applied to time. It pays to measure how long each rally and decline have lasted. For example, rallies in a bull market are often interrupted by declines that last approximately half as long as the preceding rallies. If you discover that rallies tend to last 8 days and declines 5 days, that knowledge encourages you to look for a buying opportunity 4 days into a decline. The factor of 5. Analysts often feel confused when they look at charts in different time frames and see that the market is going in several directions at once. The trend may be up on the daily charts, but down on the weeklies, and vice versa. Which of these trends will you follow? This becomes even more complex if you look at intraday charts. Most traders pick one time frame and close their eyes to others until a sudden move outside of their time frame hits them. The factor of 5 links all time frames. If you start with monthly charts and proceed to the weeklies, you will notice that there are 4.5 weeks to a month. As you switch to daily charts, you will see 5 trading days to a week. As your time frame narrows, you will look at hourly charts, and there are approximately 5 to 6 hours to a trading day. Day traders can proceed even further and look at 10-minute charts, followed by 2-minute charts. All are related by the factor of 5. 36 times 193. The proper way to analyze any market is to analyze it in at least 2 time frames. They should be related by the factor of 5. When you analyze the market in 2 time frames, the shorter of them has to be 5 times shorter than the longer one. If you want to analyze daily charts, you must first examine INE weekly charts, and if you want to day trade using 10-minute charts, you first need to analyze hourly charts. This is one of the key principles of the triple screen trading system. See section 43. 6. Stock market indicators. 37. New high, new low index. Stock and futures traders used to live like 2 separate tribes. They traded different markets and used different analytic tools. The wall between them began to crumble after stock index futures were created in 1982. Both tribes rushed to trade them. An astute trader owes it to himself to master the tools of both tribes. Shrewd stock traders use stochastic, moving averages, and other tools of futures analysts. Futures and options traders can time their stock index trades better by using stock market indicators. They include the new high, new low index, probably the best leading indicator of the stock market, the Traders Index, TRIN, and several others. How to construct an HNL. The new high, new low index, HNL, tracks the numbers of market leaders. It measures the number of stocks that have reached new highs or lows for the year on any given day. The stocks on the list of new highs are the leaders in strength, and the stocks on the list of new lows are the leaders in weakness. NHNL confirms trends when it rallies or falls in gear with prices. It identifies tops and bottoms in the stock market when it diverges from prices. The new high, new low index measures daily differences between new 194, 37, new high, new low index 195, highs and new lows. The new high, new low index is easy to calculate by hand, using information from the market diary section of most major news papers. NHNL equals new highs, new lows. New highs and new lows are reported by most data services in the United States. Make sure that your data vendor calculates new highs and lows over a 52-week period. Some use the ancient calendar method and calculate new highs and lows going back only to January. Plot the new high, new low index as a histogram with a horizontal reference line at 0 level. On the days when there are more new highs than new lows, NHNL is positive and plotted above the center line. On the days when there are more new lows than new highs, NHNL is negative and plotted below the center line. If the numbers of new highs and new lows are equal, NHNL is 0. Crowd psychology. A stock appears on the list of new highs when it is the strongest it has been in a year. This shows that a herd of eager bulls is chasing its shares. A stock appears on the list of new lows when it is the weakest it has been in a year. This shows that a crowd of aggressive bears is dumping its shares. The new high, new low index tracks the strongest and the weakest stocks on the exchange and compares their numbers. It measures the balance of power between the leaders in strength and the leaders in weakness. This is why NHNL is a leading indicator of the stock market. The broad indexes, such as the S&P 500, tend to follow the trend of NHNL, figure 37.1. You can visualize the 2,000 stocks on the New York Stock Exchange as a regiment of 2,000 men. If each stock is a soldier, then new highs and new lows are the officers. New highs are the officers who lead the attack up a hill, and new lows are the officers who are deserting and running downhill. There are no bad soldiers, only bad officers, say the military experts. The new high, new low index shows whether more officers lead the attack uphill or run downhill. When NHNL rises above its center line, it shows that bullish leadership is stronger. When NHNL falls below its center line, it shows that bearish leadership is stronger. If the market rallies to a new high and NHNL rises to a new peak, it shows that bullish leadership is growing and the uptrend is likely to. 196 stock market indicators. 337, 322, 396, 291, 275, 247, 155, 64, minus 28, minus 129. Stocks making new highs for the year are the leaders in strength, and stocks making new lows are the leaders in weakness. NHNL measures the direction and intensity of market leadership by comparing the number BER of new highs and new lows. In the summer of 1987, mass bullishness rose to a high pitch as the bull market roared into its final peak. It was safe to hold stocks as long as each new high in the stock market was confirmed by a new peak in the new high, new low index, A, B, C, D, and E. The August peak in the stock market was accompanied by a bearish divergence, EF, in the NL index, giving a sell signal. When the stock market declined in September, many traders went bargain hunting. 5 years of rising prices had trained them to use declines for buying. NHNL, meanwhile, pointed to a severe weakness. It peaked out at only 100 C, indicating weakness. NHNL turned negative in October H. It gave repeated sell signals in advance of his Torah crash. Continue. If the market rallies but NHNL shrinks, it shows that the uptrend is in trouble. A regiment whose officers are deserting is likely to turn and ran. A new low in NHNL shows that the downtrend is likely to persist. If officers are running faster than men, the regiment is likely to be routed. If stocks fall, but NHNL turns up, it shows that officers are no longer running. 37. New high, new low index 197. When officers regain their morale, the whole regiment is likely to rally. Figures 37-2 and 37-3. Trading rules. Traders need to pay attention to 3 aspects of NHNL listed here in the order of their importance. Divergences between the peaks and bottoms of NHNL and prices, the trend of NHNL, and the level of NHNL above or below its center line. 328, 308, 272, 244, 216, 96, minus 246, minus 588, minus 929, minus 1,271. Figure 37-2. New high, new low index. The stock market crashed in October 1987, and the number of new lows exploded, reaching nearly 1,300 A. The stock market bounced, a dead cat bounce, and fell back to its lows B. The newspapers were filled with alarmist articles, wondering whether this was the end of the Western financial system as we knew it. NHNL flashed a much more optimistic message. It showed that new lows were shrinking, though officers were refusing to run. The market retested its lows in December C, and NHNL traced an even stronger bullish divergence, giving a buy signal. It was confirmed when NHNL crossed into positive territory D. This was the beginning of a 2-year bull market. 198 stock market indicators. Giuntre ul bag sip 5 chirovre. Figure 37-3. New high, new low index. The new high, new low index gives its best messages when it diverges from prices. This chart shows what happened prior to the 1989 mini crash and how the recovery began. The market reached a new peak in August, accompanied by a new peak in NHNL, which indicated that the market was likely to go higher. The rally in September B was accompanied by a bearish divergence that gave a sell signal. The market struggled to a new high in October C, but NHNL made a lower peak, repeating its sell signal. NHNL turned negative 1 day prior to the crash, forcefully confirming its sell signal. The October low, D, was followed by a reflex rally, a dead cat bounce, and then prices twice retested their October lows, E, F. On both occasions, NHNL made more shallow bottoms than in October. These bullish divergences gave by signals, and a new uptrend began. As long as a price peak is confirmed by a new high in NHNL, the rally is likely to continue, even if it is punctuated by a decline. When low prices are accompanied by new lows in NHNL, it means that bears are in control, and the downtrend is likely to continue. Divergences between NHNL and broad. 37. New high new low index 199. Market averages provide the best trading signals. A trend that loses its lead. Airs is likely to reverse. 1. If NHNL traces a lower peak while the market rallies to a new high, it creates a bearish divergence. This shows that bullish leadership is weakening even though the broad market is higher. Bearish diver. Janks mark the ends of uptrends. If the last peak in NHNL is about plus 100 or less, then a major reversal is probably at hand, and it is time to get short. If the latest peak is much higher than plus 100, then the upside leadership is strong enough to prevent the market from collapsing. 2. If NHNL traces a more shallow bottom while the market declines to a new low, it creates a bullish divergence. This shows that bearish lead. Earship is shrinking even though the market is lower. If the latest low in NHNL is near minus 100, it shows that the bearish leadership is exhausted and a major upside reversal is near. If the latest low is much lower than minus 100, then bears still have some strength in the down. Trend may pause, but not reverse. Keep in mind that bullish diver. Janks at stock market bottoms tend to develop faster than bearish. Divergences at market tops buy fast and sell slowly. The slope of NHNL on any given day is defined by the trend of its bars. For the last few days, when a market rallies and NHNL rises, it confirms uptrends. When NHNL declines together with the market, it confirms downtrends. 3. A rise in NHNL shows that it is safe to hold long positions and add to them. If NHNL declines while the broad market stays flat or rallies, it's time to take profits on short-term long positions. When NHNL falls, it shows that the bearish leadership is strong and it is safe to hold short positions and even add to them. If the market continues to fall, but NHNL rises, the downtrend is in question. It is time to cover shorts. 4. If NHNL rises on a flat day, it flashes a bullish message and gives a buy signal. It shows that officers are going over the top while the soul deers are still crouching in their foxholes. When NHNL falls on a flat day, it gives a signal to sell short. It shows that officers are deserting while the troops are still holding their positions. Soldiers are not stupid. If the officers run, they will not stay and fight. 200 stock market indicators. The position of NHNL in relation to its center line shows whether bulls or bears are in control. When NHNL is above its center line, it shows that more market leaders are bullish than bearish. Then it is better to trade the stock market from the long side. When NHNL is below its center line, it shows that bearish leadership is stronger and it is better to trade from the short side. NHNL can stay above its center line for months at a time in bull markets and below its center line for months at a time in bear markets. It signals that a bull move is likely to begin. Then it is time to look for buying opportunities using oscillators for precise timing. If NHNL stays positive for several months, but then falls below its center line, it shows that a bear move is likely to begin. Then it is time to look for shorting opportunities using oscillators for precise timing. More on NHNL. Old analysts used to smooth NHNL using 10-day and 30-day simple MOV. Engineer averages. When a 10-day MA of NHNL crossed above a 30-day MA, it gave a buy signal. When a 10-day MA crossed below a 30-day MA, it gave a sell signal. Raw NHNL gives clearer signals, but if you still want a smooth NHNL, it is better to use exponential moving averages. The number of new highs and new lows is reported daily by the New York Stock Exchange, the American Stock Exchange, the over-the-counter exchange, and the London Stock Exchange. Most overseas stock exchanges do not report these numbers, but a computer-equipped analyst should have no difficulty creating NHNL for any market. Traders who use NHNL outside of the United States get an edge over competitors who lack this indicator. You need to obtain 1 year's worth of daily data for every stock on the exchange you follow and update that file daily. Program your computer to examine your database each day and flag those stocks that have reached a new high or a new low for the past 52 weeks. NHNL does not work in the stock markets dominated by a handful of stocks. For example, hundreds of stocks are listed on the Milan Stock Exchange in Italy, but only 2 of them, Fiat and General, represent nearly 70% of total market capitalization. These 2 giants can override the rest of the market. 38. Traders Index and other stock market indicators 201. 38. Traders Index and other stock market indicators. The Traders Index, TRIN, is a leading stock market indicator. It shows when major rallies and declines get ready to reverse by measuring the intensity of optimism of the dominant market group. Excessive optimism is associated with market tops and excessive pessimism with bottoms. TRIN measures the ratio of advancing to declining stocks and compares it to the ratio of advancing to declining volume. This indicator was popularized by Richard Arms and is included in most quote systems. Any broker with a terminal on his desk can punch a few keys and see the latest TRIN. It is easy to calculate TRIN by hand or by using a computer at the end of each trading day. New market developments have changed TRIN over the years. Listed stock options, index arbitrage, dividend recapture plays, and so on. The final interpretation of TRIN had to be adjusted, but TRIN continues to stand out as one of the best stock market indicators. It helps in timing stock trades, as well as trades in stock index futures and options. How to construct TRIN. You need 4 pieces of data to calculate the trader's index, the number and volume of advancing and declining stocks, as well as the volume of both groups. These figures are released by the New York Stock Exchange and several other exchanges throughout each trading session. ADV issues, ADV volume. TRIN equals -- DECL issues DECL volume. TRIN compares the relationship between the ratio of advancing and declining stocks and the ratio of advancing and declining volume. See work sheet, figure 38.1. If 1,000 stocks rally on a volume of 100 million shares, and 1,000 stocks decline on a volume of 100 million shares, then TRIN equals 1. If 1,500 stocks go up on a volume of 150 million shares and 500 stocks go down on a volume of 50 million shares, TRIN remains 1. TRIN falls when the volume of advancing stocks is disproportionately high compared to their number. TRIN rises when the volume of declining stocks is disproportionately high compared to their number. 200 stock market indicators. The position of NHNL in relation to its center line shows whether bulls or bears are in control. When NHNL is above its center line, it shows that more market leaders are bullish than bearish. Then it is better to trade the stock market from the long side. When NHNL is below its center line, it shows that bearish leadership is stronger and it is better to trade from the short side. NHNL can stay above its center line for months at a time in bull markets and below its center line for months at a time in bear markets. 5. If NHNL stays negative for several months, but then rallies above its center line, It signals that a bull move is likely to begin. Then it is time to look for buying opportunities using oscillators for precise timing. If NHNL stays positive for several months, but then falls below its center line, it shows that a bear move is likely to begin. Then it is time to look for shorting opportunities using oscillators for precise timing. More on NHNL. Old analysts used to smooth NHNL using 10-day and 30-day simple MOV. Engineer averages. When a 10-day MA of NHNL crossed above a 30-day MA, it gave a buy signal. When a 10-day MA crossed below a 30-day MA, it gave a sell signal. Raw NHNL gives clearer signals, but if you still want to smooth NHNL, it is better to use exponential moving averages. The number of new highs and new lows is reported daily by the New York Stock Exchange, the American Stock Exchange, the over-the-counter exchange, and a London Stock Exchange. Most overseas stock exchanges do not report these numbers, but a computer-equipped analyst should have no difficulty creating NHNL for any market. Traders who use NHNL outside of the United States get an edge over competitors who lack this indicator. You need to obtain 1 year's worth of daily data for every stock on the exchange you follow and update that file daily. Program your computer to examine your database each day and flag those stocks that have reached a new high or a new low for the past 52 weeks. NHNL does not work in the stock markets dominated by a handful of stocks. For example, hundreds of stocks are listed on the Milan Stock Exchange in Italy, but only 2 of them, Fiat and General, represent nearly 70% of total market capitalization. These 2 giants can override the rest of the market. 38. Traders Index and Other Stock Market Indicators 201. 38. Traders Index and Other Stock Market Indicators. The Traders Index, TRIN, is a leading stock market indicator. It shows when major rallies and declines get ready to reverse by measuring the intensity of optimism of the dominant market group. Excessive optimism is associated with market tops and excessive pessimism with bottoms. TRIN measures the ratio of advancing to declining stocks and compares it to the ratio of advancing to declining volume. This indicator was popularized by Richard Arms and is included in most quote systems. Any broker with a terminal on his desk can punch a few keys and see the latest TRIN. It is easy to calculate TRIN by hand or by using a computer at the end of each trading day. New market developments have changed TRIN over the years. Listed stock options, index arbitrage, dividend recapture plays, and so on. The final interpretation of TRIN had to be adjusted, but TRIN continues to stand out as one of the best stock market indicators. It helps in timing stock trades, as well as trades in stock index futures and options. How to construct TRIN. You need 4 pieces of data to calculate the trader's index, the number and volume of advancing and declining stocks, as well as the volume of both groups. These figures are released by the New York Stock Exchange and several other exchanges throughout each trading session. ADV issues, ADV volume. TRIN equals -- DECL issues, DECL volume. TRIN compares the relationship between the ratio of advancing and declining stocks and the ratio of advancing and declining volume. See work sheet, figure 38.1. If 1,000 stocks rally on a volume of 100 million shares and 1,000 stocks decline on a volume of 100 million shares, then TRIN equals 1. If 1,500 stocks go up on a volume of 150 million shares and 500 stocks go down on a volume of 50 million shares, TRIN remains 1. TRIN falls when the volume of advancing stocks is disproportionately high compared to their number. TRIN rises when the volume of declining stocks is disproportionately high compared to their number. 202 Stock Market Indicators. S&P 500. Date ADV DECL, ADV vol 1 DEC I vol. TRIN, 1 TRIN, 13 EMA. 6 april 784 765 83 74 7177. 6 mai 661 895 7162 9497. June 6 681 861 6339 I 8783. 1.10 I. 6 juli 445 11 13 32 51 I 11771 I 145. 6 648 4230 6644 J 1.12. June 1st 868 L 9371. 4831 1.66. 6 12 356 12 37 rok 2049 J 12 906 I 1.81. 6 13 765 67 87 styczeń 5420 rok J.83. 6 14 10 36 1 Sib 11529 1 4123 1.70. Juin 2017 645 851 4518 à 6916 J 1.16. 6 18 6 22 895 52611 8177 1.08. 6 19 399 11 59 24 53 I 11567 I 162. Juin 2020 655 854 6305 J 7734 1.10. 684 11192 J 5239 J.58 1.02. Juin 2024 298 322 202 1 11592 J 2.17 J 1.18. 625 612 888 5216 I 8171 1.08 1.17. Figure 38 1. Traders Index TRIN worksheet. TRIN tracks the ratio of advancing to declining stocks and compares it with the ratio of advancing to declining volume. It works best when it is smooth with an exponential moving average, such as a 13-day EMA. The volume of advancing stocks often swells out of proportion to their number during rallies. If the ratio of advancing to declining issues is 2 to 1, but the ratio of advancing to declining volume is 4 to 1, then TRIN equals 0.50, 2 to 1, plus 4/1. A low TRIN shows that bulls are highly optimistic, a rally is being overdone, and a top is near. When a market falls, the volume of declining stocks often swells out of proportion to their number. If the ratio of advancing to declining issues is 1 to 2, but the ratio of advancing to declining volume is 1 to 4, then TRIN equals 2, 1/2 plus 1/4. A high TRIN shows that bears are too optimistic, too much. Volume goes into the declining stocks, a decline is being overdone, and the market is nearing a bottom. TRIN can change sharply from day to day. TRIN gives better signals when it is smoothed with a moving average. You can use a 13-day exponent, 38, Traders Index, and other stock market indicators 203. Tile moving average of daily TRIN. See section 25. It filters out the noise of daily swings and shows the true trend of this indicator. For the rest of this chapter, the term TRIN is used as shorthand for 13-day EMA of daily TRIN. Plot TRIN on an inverted vertical scale. Low numbers on the top identify market peaks, and high numbers at the bottom identify market lows. 2. Horizontal reference lines mark overbought and oversold levels. When TRIN rises above its upper reference line, it shows that the stock market is overbought and nearing a top. When TRIN falls below its lower reference line, shows that the market is oversold and nearing a bottom. The level of reference lines depends on whether the stocks are in a bull or bear market or a neutral trading range. The overbought line is usually placed at 0.65 or 0.70 in bull markets, 0.70 or 0.75 in bear markets. The oversold line is placed at 0.90 or 0.95 in bull markets, 1.00 or 1.10 in bear markets. These levels may shift by the time you read this book. Use them as a start. ING point for your own research. The best way to draw reference lines is to examine a chart of an index, such as the S&P 500 for the past 6 months, along with TRIN. Mark all important tops and bottoms of the S&P 500 and draw 2 reference lines that cut across the corresponding tops and bottoms of TRIN. When TRIN enters those extreme areas again, you will know that the market has entered a reversal zone. Adjust oversold and overbought lines every 3 months. Crowd psychology. The stock market is a manic depressive beast. It swings from expansive mania to fearful depression. The mood of a manic depressive patient goes through cycles. When he reaches the bottom of depression, his mood starts to improve. When he rises to the height of mania, he starts to slow down. Traders can use TRIN to diagnose manic and depressive episodes in the stock market and bet on their reversals. See Figure 38.2. Crowds are emotional and short-term oriented. Trends often go farther than you expect because crowds act out their feelings and run instead of act. Ingegner razionali. Trends reverse when masses of traders get tired of running. TRIN shows when they become exhausted. If bulls become greedy during a rally, they buy so many shares that advancing volume swells out of proportion with the number of advancing stocks. When TRIN rises above its upper reference line, it shows that mass optimism has risen to a level associated with tops. 204 stock market indicators. 30, 348, 337, 325, 314, -08, -0.78, -0.89, -0.99, -1.09. When the volume of rising stocks rises out of proportion to their number, it reflects bullish enthusiasm, and TRIN becomes overbought. It rises and then flashes a sell signal when it leaves its overbought zone. When the volume of declining stocks becomes too large relative to their number, TRIN becomes oversold. It gives a buy signal when it leaves its oversold zone. TRIN gives its best buy and sell signals when it diverges from the pattern of the S&P 500 index. The market rose higher in October than in September, but TRIN reached a lower top, giving a strong sell signal. After the October fall, the market retested its bottom in November, but a much higher bottom in TRIN showed that bears were out of breath. This bullish divergence gave a strong buy signal. At the right edge of the chart, the market is strong, but TRIN is nowhere near overbought hold. Longs. If bears dump shares during a decline, then downside volume swells out of proportion with the number of declining stocks. When TRIN falls below its lower reference line, it shows that bearishness is being overdone and an upside reversal is near. 38. Traders Index and other stock market indicators 205. Changes of TRIN are similar to what happens during rush hours at a suburban commuter train station. In the morning, the departure platform gets overcrowded, while at night, there is a crowd at the arriving platform. The biggest crowd identifies the peak of the trend, either into the city or back home. You can identify traffic reversals by measuring the number of commuters crowding a platform. That is what TRIN does in the stock market. TRIN identifies rush hours and uptrends and downtrends. It flags bullish extremes at stock market tops and bearish extremes at market bottoms. TRIN identifies mood swings of the stock market crowd. Professionals use this information because they tend to trade against deviations and for a return to normalcy. Trading rules. TRIN is plotted on an inverted scale. High numbers mark the bottoms, and low numbers signal market tops. TRIN hovers between 0.75 to 0.85 in new trial markets. It is less than 1.0 because the volume of advancing stocks normally exceeds the volume of declining stocks. People are normally more bullish than bearish. TRIN cannot be used mechanically. The same readings mean different things under different market conditions. Overbought and oversold readings are lower during bear markets and higher during bull markets. For example, TRIN of 0.60 marks great bullish strength at an early stage of a bull market. It tells you to look for every opportunity to add to long positions. The same read, ING of 0.60 during a rally in a bear market marks a major shorting opportunity. This is why it pays to adjust overbought and oversold lines every 3 months. 1. Buy when TRIN leaves its oversold zone. When it crosses above its lower reference line, it shows that bears have run out of steam. Buying at this time is like betting on a traffic reversal after the rush hour. 2. Sell when TRIN leaves its overbought zone. When TRIN sinks below its upper reference line, it shows that bulls are running out of breath. Selling short at this time is safer than trying to pick the exact top. 3. TRIN works best when combined with a new high, new low index. See section 37. If TRIN becomes oversold while Chanel reaches a new low, it shows that bearish leadership is strong and the downtrend is likely to continue. If TRIN becomes oversold but NH 206 stock market indicators, NL traces a bullish divergence. It marks an important low. The calm buying signals of TRIN and NL give traders confidence to buy a larger position. 4. If TRIN becomes overbought but NL rises to a new high, it shows that the upside leadership is strong and the uptrend is likely to continue. If TRIN becomes overbought while NL traces a bearish divergence, it often marks an important stock market top. Then you can short a larger position. TRIN gives its strongest buy and sell signals when it diverges from prices. 5. When the stock market rises to a new high but TRIN traces a lower peak than it did during its previous rally, it shows that bulls are losing power. When bulls cannot purchase as many shares as before, the uptrend is in trouble. A bearish divergence between TRIN and the stock market gives a strong sell signal. 6. When the stock market falls to a new low but TRIN flattens out at a more shallow level than during its previous decline, it shows that bears have fewer stocks to sell. When bears start losing power, the market is ready to rally. A bullish divergence between TRIN and the stock market gives a strong buy signal. More on TRIN. The New York Stock Exchange releases information on advancing and declining stocks and their volume throughout each trading session. Intraday, TRIN can be used by day traders. TRIN can be applied to any stock exchange that reports the numbers of advancing and declining stocks and their volume. When that data becomes available for overseas exchanges, the first traders to use it will have a competitive advantage. Advance/decline. The advance/decline line, A/D line, measures mass participation in rallies and declines. If new highs and new lows are the officers and the Dow 38 Traders Index and other stock market indicators 207. Jones Industrials are the generals. Then the A/D line shows whether or not the soldiers are following their leaders. A rally or decline is more likely to persist when the A/D line rises to a new high or falls to a new low in gear. With the Dow, to calculate A/D for each day, subtract the number of declining stocks from a number of advancing stocks and ignore unchanged stocks. The result is positive or negative depending on whether more stocks advanced or declined. For example, if 1,900 stocks were traded, 900 advanced, 700 declined, and 300 were unchanged, then advance/decline equals plus 200, 900, 700 Each day's advance/decline figures are added to the previous day's total, creating a cumulative A/D line. Traders should keep an eye on new peaks and valleys in the A/D line because its absolute level depends mostly on its starting date. Broadly based, rallies and declines have greater staying power. If a new high in the stock market is accompanied by a new high in the A/D line, it shows that the rally has broad support and is likely to continue. If the stock market reaches a new peak but the A/D line reaches a lower peak than during the previous rally, it shows that fewer stocks are participating and the rally may be near its end. When a market falls to a new low but the A/D line traces a more shallow bottom than during the previous decline, it shows that the decline is narrow. ING down and the bear move is nearing an end. These signals tend to precede reversals by weeks, if not months. Most active stocks. The most active stocks indicator, MAS, is an advance/decline line of the 15 most active stocks on the New York Stock Exchange. They are listed daily in many newspapers. Several large capitalization stocks, such as IBM, frequently appear on this list. Other stocks make the list only when they catch the public's eye due to an extremely positive or negative piece of news. MAS is a big money indicator. It shows whether big money is bullish or bearish. MAS for each day equals the number of the most active stocks that advanced minus the number of the most active stocks that declined. For example, if 9 of the most active stocks went up, 4 fell, and 2 were unchanged, then MAS for that day is 5, 9 of 4. Each day's MAS is added to the previous day's total, creating a cumulative MAS line. When MAS moves in the same direction as the broad stock market, 208 stock market indicators shows that big money supports the trend and it is likely to continue. When the market goes one way and MAS goes the other way, it shows that big money is betting on a reversal. When the trend of MAS diverges from the price trend, the market is especially likely to reverse. Other stock market indicators. Only a few stock market indicators have withstood the test of time. The new High New Low Index and TRIN are probably the best stock market indicators, followed by advance/decline and most active stocks. Old stock market books are full of fascinating indicators, but you have to be very careful using them today. Changes in the market over the years have killed many indicators. Indicators based on volume of low-price stocks lost their usefulness. When the average volume of the U.S. stock market soared tenfold and the Dow rose sixfold, the member short sale ratio and the specialist short sale ratio stopped working after options became popular. Member and SP Silas short sales are now tied up in the intermarket arbitrage. Odd lot. Statistics lost value when conservative odd lotters bought mutual funds. The odd lot short sale ratio stopped working when gamblers discovered puts. 7. Psychological indicators. 39. Consensus indicators. Many private traders keep their market opinions to themselves, but financial journalists and market letter writers spew them forth like open fire hydrants. Some writers are very bright, but both groups as a whole have poor trading records. Financial journalists and letter writers overstay important trends and miss major turning points. When these groups become bullish or bearish, it pays to trade against them. The behavior of groups is more primitive than individual UAL behavior. Consensus indicators, also known as contrary opinion indicators, are not as exact as trend-following indicators or oscillators. They simply draw your attention to the fact that a trend is ready to reverse. When you get that MES, Sage, use technical indicators for more precise timing. As long as the market crowd remains in conflict, the trend can continue. When the crowd reaches a strong consensus, the trend is ready to reverse. When the crowd becomes highly bullish, it pays to get ready to sell. When the crowd becomes strongly bearish, it pays to get ready to buy. The foundations of the contrary opinion theory were laid by Charles Mackay, a Scottish barrister. he described in his book Extraordinary Popular Delusions and the Madness of Crowds, crowd behavior during the Dutch tulip mania and the South Seas bubble in England. Humphrey B. Neal applied the theory of contrary opinion to stocks and other financial. And 210 psychological indicators. Markets. He explained in his book, The Art of Contrary Thinking, why the majority must be wrong at the market's major turning points. Prices are established by crowds, and by the time the majority turns bullish, there are not enough new buyers left to support a bull market. Abraham W. Cohen, a New York lawyer, came up with the idea of polling market advisors and using their responses as a proxy for the entire body of traders. Cohen was a skeptical man who spent many years on Wall Street and saw that the advisors as a group performed no better than the market crowd. In 1963, he established a service called Investors Intelligence for tracking market letter writers. When a majority of them became bearish, Cohen identified a buying opportunity. Selling opportunities were marked by strong bullishness among letter writers. James H. Sibbett applied this theory to commodities. In 1964, he set up an advisory service called Market Vein. He studied the opinions of advisors and also weighed them in proportion to the numbers of their subscribers, tracking advisory opinion. Some letter writers are very smart, but taken as a group, they are no better than average traders. They become very bullish at major tops and very bearish at major bottoms. Their consensus is similar to that of the trading crowd. Most letter writers follow trends because they are afraid to appear foolish and lose subscribers by missing a major move. The longer a trend continues, the louder letter writers bay at it. The advisors are most bullish at market tops and most bearish at market bottoms. When most letter writers become strongly bullish or bearish, it is a good idea to trade against them. Several rating services track the percentage of bulls and bears among advisors. The main rating services are Investors Intelligence in the stock market and Market Vein in the futures markets. Some advisors are very skilled at double talk. The man who speaks from both sides of his mouth can later claim that he was right regardless of the market's direction. Editors of Investors Intelligence and Market Vein have plenty of experience pinning down such lizards. As long as the same editor does the ratings, they remain internally consistent. Investors Intelligence. Investors Intelligence was founded by Abe Cohen in 1963. He died in 1983, and his work is being continued by Michael Burke, the new editor in Pub. 39. Consensus Indicators 211. Lisher. Investors Intelligence monitors about 130 stock market letters. It taboo lates the percentage of bulls, bears, and fence sitters among letter writers. The following example illustrates what happens when the consensus changes among 1,000 traders who hold 12,000 contracts in one market. Open. Interest. Bullish. Consensus. Number of bulls. Number of bears. Contracts. Bid bull. Contracts. Per bear. 5002424. 80,800,215.60. 20,200,860.15. 1. If bullish consensus equals 50%, then 50% of traders are long and 50% are short. An average trader who is long holds as many contracts as an average trader who is short. 212 psychological indicators. 78. 65. 18. 55. 58. 45. 48. 35. 38. 25. Figure 39. 1. Bullish consensus. The opinions of market advisors serve as a proxy for the opinions of the entire market crowd. The best time to buy is when the crowd is bearish, and the best time to go short is when the crowd is bullish. The levels of bullishness at which to buy or sell short vary from market to market. They need to be adjusted every few months. This weekly chart shows a bull market in the D. Mark steadily MOV. ING up between a trend line and a parallel channel line. Whenever Bullish consensus fell below 45% during this bull market. It gave a buy signal. The lower the bullish consensus, the more explosive the subsequent rally. D. Mark weekly. Bullish consensus. 41 of /M 3841. Copyright 31. Unewe okstik fip he okstik ma neyu sipnovien. 2. When bullish consensus reaches 80%, it shows that 80% of traders are long and 20% are short. Since the sizes of total long and total short positions are always equal, an average bear is short 4 times as many contracts as are held long by an average bull. This means that an average bear has 4 times more money than an average bull. The big money is on the short side of the market. 3. When bullish consensus falls to 20%, it means that 20% of 39 consensus indicators 213 traders are long and 80% are short. Since the numbers of long and short contracts are always equal, an average bull holds 4 times more contracts than are held by an average bear. It shows that big money is on the long side of the market. Big money did not grow big by being stupid. Big traders tend to be more knowledgeable and successful than average, otherwise they stop being big traders. When big money gravitates to one side of the market, think of trad, ing in that direction. To interpret bullish consensus in any market, obtain at least 12 months of historical data on consensus and note the levels at which the market has turned in the past. Figure 39, 1. Update these levels once every 3 months. The next time the market consensus becomes highly bullish, look for an opportunity to sell short using technical indicators. When the constant SUS becomes very bearish, look for a buying opportunity. Advisory opinion sometimes begins to change a week or 2 in advance of major trend reversals. If bullish consensus ticks down from 78 to 76, or if it rises from 25 to 27, it shows that the savviest advisors are abandoning what looks like a winning trend. This means that the trend is ready to reverse. Signals from the press. To understand any group of people, you must know what its members want and what they fear. Financial journalists want to appear serious, intelligent, and informed. They're afraid of appearing ignorant or flaky. It is normal for financial journalists to straddle the fence and present several sides of every issue. A journalist is safe as long as he writes something like monetary pole. IC is about to push the market up unless unforeseen factors push it down. Internal contradiction is the normal state of affairs in financial journalism. Many financial editors are even bigger cowards than their writers. They print contradictory articles and call this presenting a balanced picture. For example, a recent issue of Business Week had an article headlined, "The winds of inflation are blowing a little harder," on page 19. The arty, CLE stated that the end of a war was likely to push oil prices up. Another arty, CLE, on page 32 of the same issue was headlined, "Why the Inflation Scare Is." Just that. It stated that the end of a war was going to push oil prices down. Only a powerful and long-lasting trend can lure journalists and editors. 214 psychological indicators. 666. 648. 628. 688. 588. 568. 548. 528. 588. 488. Figure 39, 2. Advertising as a contrary indicator. By the time several firms prepare ads for the same product and place them in the same newspaper, the trend is ready to reverse. More than 3 ads for the same market on the same page is a bearish warning. 5 ads for Jatnam on the wall, down from their fences. This happens when a wave of optimism, or pessimism, sweeps the market at the end of a major trend. When journalists climb down from the fence and express strongly bullish or bearish views, the trend is ripe for a reversal. This is also the reason why the front covers of major business magazines are good contrarian indicators. When Business Week puts a bull on its cover. It is usually a good time to take profits on long positions in stocks, and when a bear graces the front cover, a bottom cannot be too far away. Signals from the advertisers. A group of 3 or more ads touting the same opportunity on the same page of a major newspaper often warns of a top. Figure 39, 2. Only a well. 40. Commitment indicators 215. Established uptrend can break through the inertia of several brokerage firms. By the time all of them recognize a trend, come up with trading recommendations, produce ads, and place them in a newspaper, that trend is very old. The ads on the commodities page of the Wall Street Journal appeal to the bullish appetites of the least informed traders. Those ads almost never recommend selling. It is hard to get amateurs excited about going short. When 3 or more ads on the same day tout opportunities in the same market, it is time to look at technical indicators for shorting signals. 40. Commitment indicators. Several government agencies and exchanges collect data on buying and sell ING by several groups of investors and traders. They publish summary reports of actual trades, commitments of money as well as ego. It pays to trade with those groups that have a track record of success and bet against those with poor track records. For example, the Commodity Futures Trading Commission, CFTC, reports long and short positions of hedgers and big speculators. Hedgers, the commercial producers and consumers of commodities, are the most successful participants in the futures markets. The Securities and Exchange Commission, SEC, reports purchases and sales by corporate insiders. Officers of publicly traded companies know when to buy or sell their company shares. The New York Stock Exchange reports the number of shares bought, sold, and shorted by its members and by odd lot traders. Members are more successful than small-time speculators. Commitments of traders. Traders must report their positions to the CFTC after they reach certain levels, called reporting levels. At the time of this writing, if you are long or short 100 contracts of corn or 300 contracts of the S&P 500 futures, the CFTC classifies you as a big speculator. Brokers send reports on positions that reach reporting levels to the CFTC. It compiles them and releases some. Marries once every 2 weeks. The CFTC also sets up the maximum number of contracts, called position. 216 psychological indicators. Limits that a speculator is allowed to hold in any given market. At this time, a speculator may not be net long or short more than 2,400 contracts of COM or 500 contracts of the S&P 500 futures. These limits are set to prevent very large speculators from accumulating positions that are big enough to bully the markets. The CFTC divides all market participants into 3 groups: commercials, small speculators, and large speculators. Commercials, also known as hedgers, are firms or individuals who deal in actual commodities in the normal course of business. In theory, they trade futures to hedge business risks. For example, a bank trades interest rate futures to hedge its loan portfolio, or a food processing company trades wheat futures to offset the risks of buying grain. Hedgers post smaller margins and are exempt from speculative posy. Tie-in limits. Large speculators are those traders whose positions reach reporting levels. The CFTC reports buying and selling by commercials and large speculators. To find the positions of small traders, you need to subtract the holdings of the first 2 groups from the open interest. The divisions between hedgers, big speculators, and small speculators are somewhat artificial. Smart small traders grow into big traders, dumb big traders become small traders, and many hedgers speculate. Some market participants play games that distort the CFTC reports. For example, an acquaintance who owns a brokerage firm sometimes registers his wealthy speculator clients as hedgers, claiming they trade stock index and bond futures to hedge their stock and bond positions. The commercials can legally speculate in the futures markets using inside information. Some of them are big enough to play futures markets against cash markets. For example, an oil firm may buy crude oil futures, divert SEV, air oil tankers, and hold them offshore in order to tighten supplies and push futures prices up. They can take profits on long positions, go short, and deliver several tankers at once to refiners in order to push crude futures down and cover shorts. This manipulation is illegal, and most firms hotly deny that it takes place. As a group, the commercials have the best track record in the futures markets. They have inside information and are well capitalized. It pays to follow them because they are successful in the long run. The few exceptions, such as orange juice hedgers, only confirm this rule. Big speculators used to be highly successful as a group until a decade or so ago. They used to be wealthy individuals who took careful risks with their own money. Today's big traders are commodity funds. These trend follow 40 commitment indicators 217. ING behemoths do poorly as a group. The masses of small traders are the proverbial wrong-way Corrigans of the markets. It is not enough to know whether a certain group is short or long. Commercials are often short futures because many of them own physical commodities. Small traders are usually long, reflecting their perennial optimism. To draw valid conclusions from the CFTC reports, you need to compare current positions to their historical norms. The modem approach to analyzing commitments of traders has been developed. Op-ed by Curtis Arnold and popularized by Stephen Breezy, publisher of the Bullish Review newsletter. These analysts measure deviations of current commitments from their historical norms. Bullish Review uses the following formula: current net, minimum net. COD index equals maximum net, minimum net, where COD index equals commitments of traders index. Current net equals the difference between commercial and speculative net positions. Minimum net equals the smallest difference between commercial and speculative net positions. Maximum net equals the largest difference between commercial and speculative net positions. Net position equals long contracts minus short contracts of any given group. When the COD index rises above 90%, it shows that commercials are uncommonly bullish and gives a buy signal. When the COT index falls below 10%, it shows that commercials are uncommonly bearish and gives a sell signal. Insider trading. Officers and investors who hold more than 5% of the shares in publicly traded companies must report their buying and selling to the Securities and Exchange Commission. The SEC tabulates insider buying and selling and releases this data to the public once a month. Corporate insiders have a record of buying stocks cheap and selling dear. Insider buying emerges after severe market drops, and insider selling excel. Errats when the market rallies and becomes overpriced. 218 psychological indicators. Buying or selling by a single insider matters little. For example, an execu Tive may sell shares in his firm to meet major personal expenses or may buy shares to exercise stock options. Analysts who researched legal insider trade ING found that insider buying or selling was meaningful only if more than 3 executives or large stockholders bought or sold within a month. These actions reveal that something very positive or negative is about to happen to the firm. A stock is likely to rise if 3 insiders buy in 1 month, and 2, fall if 3 insiders sell within a month. Stock exchange members. Membership in a stock exchange, particularly as a specialist, is a license to mint money. An element of risk does not deter generations of traders from paying hundreds of thousands of dollars for the privilege of planting their feet on a few square inches of a crowded floor. The member short sale ratio, MSSR, is the ratio of shorting by MEM bears to total shorting. The specialist short sale ratio, SSSR, is the ratio of shorting by specialists to shorting by members. These indicators used to serve as the best tools of stock market technicians. High readings of MSSR, over 85%, and SSR, over 60%, showed that savvy traders were selling short to the public and identified stock market tops. Low read, INGs of MSSR below 75% and SSR below 40% showed that members were buying from the bearish public and identified stock market bottoms. These indicators became erratic in the 1980s. They were done in the options markets, which gave exchange members more opportunities for arbitrage. Now, it is impossible to tell when their shorting is due to bearishness or to arbitrage plays. Odd lot activity. Odd lotters are people who trade less than 100 shares of stock at a time. The small fry of the stock exchange. They remind us of a more bucolic time on Wall Street. Odd lotters transacted 1/4 of the exchange volume a century ago and 1% as recently as 2 decades ago. Odd lotters as a group are value investors. They buy when stocks are cheap and sell when prices rise. The indicators for tracking the behavior of odd lotters were developed in 40 Commitment Indicators 219. The 1930s. The odd lot sales ratio measured the ratio of odd lot sales to purchases. When it fell, it showed that odd lotters were buying and the stock market was near the bottom. When it rose, it indicated that odd lotters were selling and the stock market was near the top. The odd lot short sale ratio was a very different indicator. It tracked the behavior of short sellers among odd lotters, many of whom were gamblers. Very low levels of odd lot short sales indicated that the market was near the top, and high levels of odd lot short sales showed that the stock market was at a bottom. These indicators lost value as the financial scene changed in the 1970s and 1980s. The intelligent small investors moved their money into well-run mutual funds, and gamblers discovered that they could get more bang for their money in options. Now the New York Stock Exchange has a preferential mechanism for filling odd lot orders, and many professionals trade in 99 share lots. 8. New indicators. 41. Elder Ray. Elder Ray is a new technical indicator. It was developed in 1989 by this author and named for its similarity to X-rays. Doctors use X-rays to see bone structure below the surface of the skin. Traders can use Elder Ray to see the power of bulls and bears below the surface of the markets. To be a successful trader, you do not have to forecast the future. You need to find when bulls or bears are in control and trade with the dominant group. Elder Ray helps you see when bulls and bears become stronger or weaker. How to construct Elder Ray. Elder Ray combines the best features of trend-following indicators and oscillators. See Section 24. It includes an exponential moving average, which is a trend-following indicator. Its bull power and bear power components are oscillators. To create Elder Ray, divide your computer screen or chart paper into 3 horizontal windows. Plot a bar chart and an exponential moving average, EMA, in the upper window. Plot bull power in the middle window and bear power in the bottom window. It takes 4 steps to construct Elder Ray. See worksheet, figure 41-1, 220. 41. Elder Ray, 221. Gold. High-low. Close 13 EMA, bull power, bear power. 353.5, 351.41, 351.6, 351.3, 42.16, F0.06. MMW 352.1, I 351.7, 351.39, minus 0.49. 354.2, 352.2, 354.1, 351.78, 2.42, 0.42.c. BSJGS 357.9, 354.9, 1, 357.1, 352.5, 45.36, 2.36. MWK 356.8, 355.3, 356.2, 353.06, 3.74. 355.9, 355.3. 354.1 IJ and LL 2.69 UHK. ISB. FJ 352.6, 352.5, MFCFC KLE minus 0.51, minus 2.21. 359.6, 355.2, 357.4, 353.72, 5.88, 1.48. BRNCB 357.8, 356.8, 357.4, 345.25, 3.55, 2.55, 360.8, 357.9, 358.8, 354.90. Figure 41, 1. Elder Ray Worksheet. Bull power equals high of the bar. 13-day EMA. Bear power equals low of the bar. 13-day EMA. It is normal for bull power to be positive and for bear power to be negative. The higher the bull power, the stronger the bulls, and the deeper the bear power, the stronger the bears. When bull power turns negative, it shows that the bears are so strong they completely overpower the bulls. If bear power turns positive, it shows that bulls are uncommonly strong, completely overpowering the bears. 1. Draw a bar chart of any trading vehicle in the top window of your screen. 2. Plot an EMA of closing prices in the same window. A 13-day EMA is a good choice. Bull power equals high EMA. Bear power equals low EMA. 3. Calculate bull power according to the above formula. Plot it as a histogram in the middle window. Bull power of any day equals the high of that day minus the EMA of that day. Normally, the high of a bar is above the EMA, bull power is positive, and the histogram is above. 222 new indicators. The center line. The entire bar may sink below the EMA during a sharp break. When the high is below the EMA, bull power turns negative, and its histogram falls below the center line. 4. Calculate bear power and plot it as a histogram in the bottom window. Bear power of any bar equals the low of that bar minus the EMA. Normally, the low of a bar is below the EMA, bear power is negative, and the histogram is below the center line. If the entire bar rises above the EMA during a sharp rally, then bear power turns positive and its histogram rises above the center line. Figure 41-2. Trading psychology. Elder Ray combines several pieces of information: price, a moving average, the high of each bar, and the low of each bar. We need to understand their meaning in order to understand Elder Ray. Each price is a momentary consensus of value. See Section 12. Buyers are buying because they expect prices to rise. Sellers are selling because they expect them to fall. The undecided traders are standing aside, but their presence puts pressure on bulls and bears. A trade takes place when a buyer is willing to buy and a seller is willing to sell, both prompted by fear that an undecided trader may step in and snap away an opportunity. The price of every trade reflects the latest consensus of value of any trading vehicle. A moving average shows the average consensus of value during its time window. A 10-day EMA represents the average consensus of value for the past 10 days, a 20-day EMA for the past 20 days, and so on. An exponential moving average is more reliable than a simple EMA. See Section 25. The most important message of a moving average is its slope. When it rises, it shows that the crowd is becoming more bullish. When it declines, it shows that the crowd is becoming more bearish. Trade in the direction of the slope of a moving average. The high of any bar reflects the maximum power of bulls during that bar. Bulls make money when prices rise. They keep buying until they cannot lift prices any higher. Bulls would love to raise prices one more tick, but they are out of breath. The high point of a daily bar represents the maximum power of bulls during the day. The high point of a weekly bar represents the maximum power of bulls during the week, and so on. The low of any bar represents the maximum power of bears during that. Comics cold 1 asterisk asterisk underscore slash I backslash 370.08 S. Opistishkov il 360 1 by 1 350.00 Figure 41 2 Elder Ray. The 13-day EMA reflects the average consensus of value. Its slope identity fees the market trend. Bull power reflects the ability of bulls to lift prices above the average consensus of value. Bear power reflects the ability of bears to push prices below the average consensus of value. The best buy signals are given by bullish divergences when prices fall to a new low, but bear power stops at a more shallow bottom. The best shorting signals are given by bearish divergences when prices rise to or above the previous high, but bull power reaches a lower peak. A bearish divergence in June and July gave a sell signal a double top in price, accompanied by a lower peak in bull power. The sell signal was confirmed when the 13-day EMA turned down. Bull power became positive several times during the downtrend, showing where to add to short positions. When bull power turns positive during a downtrend and then ticks down, place an order to sell short below the last day's low. A bullish divergence developed in September when gold fell to a new low, but bear power made a more shallow low. The buy signal was confirmed when the 13-day EMA of gold turned up at the right edge of the chart. The new peak in bull power confirms that the rally is strong and likely to continue. 224 new indicators. Bar. Bears make money when prices fall. They keep selling and shorting until they cannot push prices down another tick. The lowest point of a daily bar reflects the maximum power of bears during the day. The low of a weekly bar shows the maximum power of bears during the week, and so on. Elder Ray compares the maximum power of bulls and bears to the average consensus of value. It does this by measuring the spread between the high and the low of every bar and an exponential moving average. Bull power reflects the bull's ability to push prices above the average consensus of value. It measures the distance from the bar's high to the EMA. Bull power is normally positive. It rises when bulls become stronger and falls when they stumble. Bear power turns negative when bulls' heads are underwater. Bear power reflects the bear's ability to push prices below the average consensus of value. It measures the distance from the bar's low to the EMA. Bear power is normally negative. It deepens when bears grow stronger and rises when they become weaker. If bear power turns positive, it shows that very strong bulls are holding bears up in the air by the scruff of their necks. To summarize the key points of Elder Ray. 1. Price is a consensus of value expressed in action. 2. A moving average is an average consensus of value. 3. The highest point of each bar represents the maximum power of bulls during that bar. 4. The lowest point of each bar represents the maximum power of bears during that bar. 5. Bull power is the difference between the raw power of bulls and the average consensus of value. 6. Bear power is the difference between the raw power of bears and the average consensus of value. Trading rules. Elder Ray can work as a standalone trading method, but it pays to combine it with another method, such as the triple screen trading system, see section 43. If you use Elder Ray alone, remember that the slope of its EMA identifies 41. Elder Ray 225. The trend, and trade only in that direction. Use bull power and bear power too. Find entry and exit points for your trades in the direction of that trend. Triple screen, on the other hand, identifies the trend using weekly charts. It then uses bull power and bear power on the daily charts to find trades in the direction of the weekly trend. If the weekly trend is up, triple screen takes only by signals from daily Elder Ray. If the weekly trend is down, it takes only shorting signals from daily Elder Ray. Buying and selling. There are two essential conditions for buying. 1. The trend is up, identified by EMA or a weekly trend following indicator. 2. Bear power is negative but rising. The third and fourth conditions are desirable but not essential. 3. The latest peak in bull power is higher than the previous peak. 4. Bear power is rising from a bullish divergence. Do not buy when bear power is positive. This occurs in runaway uptrends when an entire bar rises above the EMA. If you buy when bears are being held up in the air, you are betting on the greater fool theory. Pay ing a high price and hoping to meet a greater fool down the road willing to buy from you at an even higher price. The best time to buy is when bear power is negative but rising, when bears regain their footing but are starting to slip again. When bear power ticks up, place a buy order above the high of the last 2 days. If the rally continues, your stop will be touched and you'll go long. Once long, place a protective stop below the latest minor low. The strongest buy signals are given by bullish divergences between bear power and price. If prices fall to a new low but bear power traces a higher bottom, it shows that prices are falling out of inertia and bears are becoming weaker. When bear power ticks up from the second bottom by a larger than usual position, bear power is useful for deciding when a pyramid. As the uptrend continues, you can add to your long position whenever bear power dips below its center line and then ticks up again. 226 new indicators. If you buy using indicators, use them to decide when to sell. Do not be distracted by every uptick and downtick of bull power. It's normal breath. ING process. You can monitor the power of bulls by tracking the pattern of peaks and valleys in bull power. As long as every new peak in price is accompanied by a new peak in bull power, the uptrend is safe. Sell when bulls start losing power. A sell signal is given when prices reach a new high, but bull power reaches a lower peak than it reached during its previous rally. Shorting and covering. There are 2 essential conditions for shorting. 1. The trend is down, identified by EMA or weekly trend following indicator. 2. Bull power is positive but falling. The third and fourth conditions are desirable but not essential. 3. The latest bottom in bear power is deeper than its previous bottom. 4. Bull power is falling from a bearish divergence. Do not sell short if bull power is already negative. This happens when the whole price bar is below the EMA during a waterfall decline. If you sell short, the strongest shorting signals are given by bearish divergences between bull power and prices. If prices rally to a new high, but bull power reaches a lower top, it shows that bulls are weaker than before and prices are rising out of inertia. When bull power ticks down from a lower top, sell short a bigger position. Bull power shows when to pyramid short positions. As a downtrend continues, you can add to your shorts whenever bull power rallies above its center line and then ticks down again. If you sell short using indicators, use them also for deciding when to. 42. Force Index 227. Cover. When the trend is down, monitor bear power to see whether bears are becoming stronger or weaker. The pattern of peaks and valleys in bear power is much more important than its single upticks and downticks. If a new low in price is accompanied by a new low in bear power, the down trend is safe. A bullish divergence occurs when prices fall to a new low but bear power traces a more shallow bottom. It shows that bears are running out of steam and prices are falling out of inertia. This is a signal to cover shorts and get ready to go long. Divergences between bull and bear power and prices mark the best trade. ING opportunities. X-rays show broken bones under healthy skin, and elder ray shows when the dominant group is broken below the surface of a trend. 42. Force Index. Force Index is an oscillator developed by this author. It measures the force of bulls behind every rally and of bears behind every decline. Force Index combines 3 essential pieces of market information: the direction of price change, its extent, and trading volume. It provides a new, practical way of using volume to make trading decisions. Force Index can be used raw, but it works better if you smooth it with a moving average. Force index smoothed with a short MA helps pinpoint entry and exit points. Force index smoothed with a long MA reveals major changes in the force of bulls and bears. How to construct force index. The force of every move is defined by its direction, distance, and volume. If prices close higher than the previous bar, the force is positive. If prices close lower than the previous bar, the force is negative. The greater the change in prices, the greater the force. The bigger the volume, the greater the force of the move. See worksheet, figure 42.1. Force index equals volume today, close yesterday. Raw force index is plotted as a histogram with a horizontal centerline at 228 new indicators. Nikkei Dow, date Mu 6 force index, J, larfourier.wl. 1029 SB, 1 Mach Phil. Octobre 2030 25242 J. A. 4495 minus 391,065. J. 10/31e 25 194 J 1372 moins 65 1856 et moins 130 807 J. 11/0 124,295 I 25 47 M dash 1 570 105. 11/0 224,195 I 28 91 minus 289,100 dash 716102 I. 11/0 5 24,385 1 1448 275 T minus 55,287. 11/0 6 23,966 I 2796 dash 117,152 4 I minus 799,445 I 11/072 3,500 I 3,675 マイナス171万2,550パイプマイナス140万8,182パイプ。 11/0 8 22,970 3,167-167万8,510パイプマイナス158万8,400 I 2/09 22,932 I dash 109 4401 350 2426 T 11/13 23,974 BJ 258 8328 I 152 4743. 11/14 21 minus 67,599 463,181. 11/15 23,487 22 12 minus 995,400 I dash 509206 I 2/I 6 23,172 2,740 1-80 万3,415マイナス74万5,345 I 2/19 23,519 1931 670 057 198,256 minus 261,590 20分の11 23,205バックスラッシュ1400 5-44万1170パイプマイナス20 28,027 I マイナス20 56,796 11/21 22816 2259 minus 878,751 minus 661,843 minus 314,660 22分の11 23,400バックスラッシュ2160 326万3,192 I 62万1514 minus 180,921. Figure 42.1. Force Index Worksheet. Force Index equals volume today, closet today, close yesterday. Short-term force index is smoothed with a 2-day exponential moving average. Intermediate-term force index is smoothed with a 13-day exponential moving average. You can use a programming trick to reduce vary. Large force index numbers simply divide force index by the latest class. ING price, a zero level. If the market closes higher, force index is positive and is plot TED above the center line. If the market closes lower, force index is negative and plotted below the center line. If the market closes unchanged, force index equals 0. The histogram of raw force index appears very jagged. This indicator gives better trading signals after being smoothed with a moving average. See Section 25. A 2-day EMA of force index provides a minimal degree of smoothing. It is useful for ending entry points into the markets. It pays to buy when the 2-day EMA is negative and sell when it is positive as long as you trade in the direction of the 13-day EMA of prices. A 13-day EMA of force index tracks longer-term changes in the force of bulls and bears. When it crosses above its center line, it shows that bulls are 42. Force index 229. In control. When it turns negative, it shows that bears are in control. Divergences between a 13-day EMA of force index and prices identify. Important turning points. Trading psychology. When the market closes higher, it shows that bulls won the day's battle. And when it closes lower, it shows that bears carried the day. The distance between today's and yesterday's closing prices reflects the margin of victory by bulls or bears. The greater this distance, the more important the victory. Volume reflects the degree of commitment by the mass of market participants. See Section 32. Prices moving at high volume are like an avalanche that gathers mass as it rolls. High volume rallies and declines, have more inertia, and are more likely to continue. Low volume, on the other hand, shows that the supply of losers is running low and a trend is nearing an end. Prices reflect what market participants think, while volume reflects their feelings. Force index combines price and volume. It shows whether the head and the heart of the market are in gear with each other. When force index rallies to a new high, it shows that the force of bulls is high and the uptrend is likely to continue. When force index falls to a new low, it shows that the force of bears is big and the downtrend is likely to persist. If the change in prices is not confirmed by volume, force index flattens out and warns that a trend is about to reverse. It also flattens out and warns that a trend reversal is near if high volume generates only a small price move. Trading rules. Short-term force index. A 2-day EMA of force index is a highly sensitive indicator of the short-term force of bulls and bears. When it swings above its center line, it shows that bulls are stronger, and when it falls below its center line, it shows that bears are stronger. A 2-day EMA of force index is so sensitive that it is best used to fine-tune signals of other indicators. When a trend-following indicator identifies 230 new indicators, 26,479, 25,189, 23,899, 22,599, 21,399, 126.1, 14.5, minus 97.9, minus 298.6, minus 329.1. This sensitive short-term indicator pinpoints buying opportunities in uptrends and shorting opportunities in downtrends. It helps traders buy weakness and sell strength. When the trend, identified by the slope of the 13-day EMA, is up and force index declines below 0, it gives a buy signal. When the trend is down and force index rallies above 0, it gives a signal to sell short. The decision when to take profits depends on whether you are a Short-term or long-term trader. If you're a short-term trader, sell longs. When force index becomes positive, or cover shorts when force index becomes negative. A long-term trader has to wait until the exponential moving average changes its direction or until there is a divergence between force index and price, marked by slanted arrows on this chart. When you're trading with the trend, you can add to your positions. Pyramid. Whenever force index gives additional signals in the direction of a trend. An uptrend, the declines of the 2-day EMA of force index spot the best buy. ING points. When a trend-following tool identifies a downtrend, a 2-day EMA of force index pinpoints the best shorting areas. Figure 42, 2. 42. Force index 231. 1. Buy when a 2-day EMA of force index turns negative during uptrends. No matter how fast and furious an uptrend, there are always pullbacks. If you delay buying until the 2-day EMA of force index turns negative, you will buy closer to a short-term bottom. When a 2-day EMA of force index turns negative during an uptrend, place a buy order above the high price of that day. If the uptrend resumes and prices rally, you will be stopped in on the long side. If prices continue to decline, your order will not be executed. Then lower your buy order to within one tick of the high of the latest bar. Once your buy stop is triggered, place a protective stop below the low of the trade day or the previous day, whichever is lower. This tight stop is seldom touched in a strong uptrend, but it gets you out early if the trend is weak. 2. Sell short when a 2-day EMA of force index turns positive and down. Trends. When trend-following indicators identify a downtrend, wait until the 2-day EMA of force index turns positive. It indicates a quick splash of bullish ness, a shorting opportunity. Place an order to sell short below the low of the latest price bar. If the 2-day EMA of force index continues to rally after you place your sell order, raise it daily to within a tick of the latest bar's low. Once prices slide and you go short, place a protective stop above the high of the latest price bar or the previous bar, whichever is higher. Move your stop down to a break-even level as early as possible. A 2-day EMA of force index helps you decide when to pyramid your positions. You can add to longs and uptrends each time force index turns negative and add to shorts and downtrends whenever force index turns positive. Force index even provides a glimpse into the future. When a 2-day EMA of force index falls to its lowest low in a month, it shows that bears are strong and prices are likely to fall even lower. When a 2-day EMA of force index rallies to its highest level in a month, it shows that bulls are strong and prices are likely to rise even higher. A 2-day EMA of force index helps decide when to close out a position. A short-term trader who buys when this indicator is negative should sell when it turns positive. A short-term trader who goes short when this indicator is positive should cover when it turns negative. A longer-term trader should get 232 new indicators out of his position only if a trend changes, as identified by the slope of a 13-day EMA of price, or if there's a divergence between 2-day EMA of force index and the trend. 3. Bullish divergences between 2-day EMA of force index and price give strong buy signals. A bullish divergence occurs when prices fall to a new low while force index makes a more shallow bottom. 4. Bearish divergences between 2-day EMA of force index and price give strong sell signals. A bearish divergence occurs when prices rally to a new high while force index traces a lower second top. A 2-day EMA of force index fits well into the triple screen trading system. See section 43. Its ability to find short-term buying and selling points is especially useful when it is combined with a longer-term trend-following indicator. Intermediate-term force index. A 13-day EMA of force index identifies longer-term changes in the strength of bulls and bears. Its position relative to its center line shows which group is in control. Its divergences from prices identify major turning points. Figure 42, 3, 5. When a 13-day EMA of force index is above the center line, bulls are in control of the market, and when it is below the center line, bears are in control. When this indicator flutters near its center line, it identifies a trendless market, a warning not to use trend-following trading methods. When a rally begins, prices often jump on heavy volume. When a 13-day EMA of force index reaches a new high, it confirms the uptrend. When the uptrend ages, prices rise more slowly or volume becomes thinner. Then a 13-day EMA of force index starts tracing lower tops and eventually drops below its center line. It signals that the back of the bull has been broken. 6. A new peak in the 13-day EMA of force index shows that a rally is likely to continue. A bearish divergence between a 13-day EMA of force index and price gives a strong signal to sell short. If prices reach a new high, but this indicator traces a lower peak, it warns that bulls are losing power and bears are ready to take control. 42. Force Index 233. Figure 42, 3 Force Index, 13-day EMA, 26,470, 25,180, 23,890, 22,599, 21,309, 40.9, 11.8, minus 17.3, minus 46.5, minus 75.6. Divergences between a 13-day EMA of force index and prices identify important turning points in the markets. A bullish divergence between a 13-day EMA of force index and the Nikkei Dow in August pointed to a buying opportunity. The Nikkei Dow retested its lows, but force index traced a much more shallow second bottom, giving a buy signal. A spike low in force index, like the one seen in August, gives two trading messages. In the long run, it usually marks the end of an emperor. Tant decline. In the short run, it tells traders that the latest price bottom is likely to be retested or exceeded. The Nikkei Dow surged higher in October, but force index kept track. ING lower tops. Its bearish divergence showed that bulls were growing. Weak in prices near the top. There was plenty of time to position short. The spike low at the right edge of the chart indicates that the latest price low is likely to be retested or exceeded. 7. A new low in 13-day EMA of force index shows that a downtrend is likely to continue. If prices fall to a new low, but this indicator traces a more shallow low, it warns that bears are losing power. This bullish divergence gives a strong buy signal. 234 new indicators. When a downtrend begins, prices usually drop on heavy volume. When a 13-day EMA of force index falls to new lows, it confirms the decline. As the downtrend grows old, prices fall more slowly or volume dries up. Then, the 13-day EMA of force index starts tracing more shallow bottoms and finally rallies above its center line. It shows that the back of the bear has been broken. 9. Trading systems. 43. Triple screen trading system. The triple screen trading system was developed by this author and has been used for trading since 1985. It was first presented to the public in April 1986 in an article in Futures magazine. Triple screen applies 3 tests or screens to every trade. Many trades that seem attractive at first are rejected by one or another screen. Those trades that pass the triple screen test have a higher degree of profitability. Triple screen combines trend-following methods and counter-trend technique. It analyzes all potential trades in several time frames. Triple screen is more than a trading system. It is a method, a style of trading. Trend-following indicators and oscillators. Beginners often look for a magic bullet, a single indicator for making money. If they get lucky for a while, they feel as if they discovered the royal road to profits. When the magic dies, amateurs give back their profits with interest and go looking for another magic tool. The markets are too complex to be analyzed with a single indicator. Different indicators give contradictory signals in the same market. Trend. Following indicators rise during uptrends and give buy signals, while oscillators become overbought and give sell signals. Trend following indicators. 235. 236 trading systems. Turn down and downtrends and give signals to sell short, but oscillators become oversold and give buy signals. Trend following indicators are profitable when markets are moving, but lead to whipsaws in trading ranges. Oscillators are profitable in trading ranges, but give premature and dangerous signals when the markets begin to trend. Traders say, the trend is your friend, and let your profits run. They also say, buy low, sell high. But why sell if the trend is up? And how high is high? Some traders try to average out the votes of trend-following indicators and oscillators. It is easy to rig this vote. If you use more trend-following tools, the vote will go one way, and if you use more oscillators, it will go the other way. A trader can always find a group of indicators telling him what he wants to hear. The triple-screen trading system combines trend-following indicators with oscillators. It is designed to filter out their disadvantages while preserve their strengths. Choosing time frames, the factor of 5. Another major dilemma is that the trend can be up and down at the same time, depending on what charts you use. A daily chart may show an uptrend, while a weekly chart shows a downtrend, and vice versa. See section 36. A trader needs to handle conflicting signals in different time frames. Charles Dow, the author of the Venerable Dow Theory, stated at the turn of the century that the stock market had 3 trends. The long-term trend lasted several years, the intermediate trend several months, and anything shorter then that was a minor trend. Robert Rhea, the great market technician of the 1930s, compared the 3 market trends to a tide, a wave, and a ripple. He believed that traders should trade in the direction of the market tide and take advantage of the waves, but ignore the ripples. Times have changed, and the markets have become more volatile. Traders need a more flexible definition of time frames. The triple-screen trading system is based on the observation that every time frame relates to the larger and shorter ones by approximately a factor of 5. See section 36. Each trader needs to decide which time frame he wants to trade. Triple screen calls that the intermediate time frame. The long-term time frame is 1 order of magnitude longer. The short-term time frame is 1 order of magnitude shorter. 43. Triple screen trading system 237. For example, if you want to carry a trade for several days or weeks, then your intermediate time frame will be defined by the daily charts. Weekly charts are 1 order of magnitude longer, and they determine the long-term time frame. Hourly charts are 1 order of magnitude shorter, and they determine the short-term time frame. Day traders who hold their positions for less than an hour can use the same principle. For them, a 10-minute chart may define the intermediate time frame, an hourly chart the long-term time frame, and a 2-minute chart the short-term time frame. Triple screen demands that you examine the long-term chart first. It allows you to trade only in the direction of the tide, the trend on the long-term chart. It uses the waves that go against the tide for entering positions. For example, daily declines create buying opportunities when the weekly trend is up. Daily rallies provide shorting opportunities when the weekly trend is down. First screen, market tide. Triple screen begins by analyzing the long-term chart, 1 order of magnitude greater than the one you plan to trade. Most traders pay attention only to the daily charts, with everybody watching the same few months of data. If you begin by analyzing weekly charts, your perspective will be 5 times greater than that of your competitors. The first screen of triple screen uses trend-following indicators to identify long-term trends. The original system uses the slope of weekly MACD histogram. See section 26 to identify the market tide. The slope is defined as a relationship between the two latest bars. When the slope is up, it shows that bulls are in control. It is time to trade from the long side. When the slope is down, it shows that bears are in control and tells you to trade. Only from the short side, figure 43.1, a single uptick or a downtick of weekly MACD histogram indicates a change of a trend. The upturns that occur below the center line give better by signals than those above the center line. See indicator seasons in section 36. The downturns that occur above the center line give better sell signals than the downturns below the center line. Some traders use other indicators to identify major trends. Steve Nadas wrote an article in Futures magazine showing how he used the directional system as the first screen of triple screen. Even a simpler tool, such as the 238 trading systems, 409.6, 393.5, 377.5, 361.4, 345.3, 2.0826, 0.9004, 8.2817, minus 1.4639, minus 2.6468. Figure 43.1. Weekly MACD histogram, the first screen of triple screen. The slope of MACD histogram is defined by the relationship between its two latest bars. See inset. Triple screen tells traders to examine weekly charts before looking at the dailies. When the weekly trend is up, it allows us to trade only from the long side or stand aside. When the weekly trend is falling, it allows us only to trade from the short side or stand aside. Weekly MACD histogram gives a buy signal when its slope turns up. The best buy signals are given when this indicator turns up below its center line. When MACD histogram turns down, it gives a sell signal. The best sell signals are given when it turns down from above its center line. See indicator seasons, section 36. Once you find the trend of the weekly MACD histogram, turn to daily charts and look for trades in the same direction. Slope of a 13-week exponential moving average can serve as the first screen of the triple screen trading system. The principle is the same. You can use most trend-following indicators as long as you analyze the trend on the weekly charts first and then look for trades on the daily charts only in that direction. 43. Triple Screen Trading System 239. Screen 1. Identify the weekly trend using a trend-following indicator and trade only in its direction. A trader has three choices: buy, sell, or stand aside. The first screen of the triple screen trading system takes away one of those choices. It acts as a sensor who permits you only to buy or stand aside during major uptrends. It allows you only to sell short or stand aside during major downtrends. You have to swim with the tide or stay out of the water. Second screen, market wave. The second screen identifies the wave that goes against the tide. When the weekly trend is up, daily declines point to buying opportunities. When the weekly trend is down, daily rallies point to shorting opportunities. The second screen applies oscillators to the daily charts in order to widen Tiffy deviations from the weekly trend. Oscillators give buy signals when markets decline and sell signals when markets rise. The second screen of the triple screen trading system allows you to take only those daily signals that point in the direction of the weekly trend. Screen 2. Apply an oscillator to a daily chart. Use daily declines during weekly uptrends to find buying opportunities and daily rallies. During weekly downtrends to find shorting opportunities. When the weekly trend is up, triple screen takes only buy signals from daily oscillators and ignores their sell signals. When the weekly trend is down, triple screen takes only shorting signals from oscillators and ignores their buy signals. Force Index and Elder are good oscillators to use with triple screen, but stochastic and Williams percent are also perform well. When the weekly MACD histogram rises, the 2-day EMA of Force Index. See Chapter 8, gives buy signals when it falls below its center line as long as it does not fall to a new multi-week low. When the weekly MACD histogram declines, force index gives shorting signals when it rallies above its center line, as long as it does not rise to a new multi-week high, figure 43.2. When the weekly trend is up, daily elder ray, see section 41, gives a buy signal when bear power declines below zero and then ticks back up toward 240 trading systems, 378.6, 378.3, 3, 2.0, 353.6, 345.3, 9, 7.1, 516.9, dash 383, minus 833.8. Figure 43, 2. Daily Force Index, the second screen of triple screen. The 2-day EMA of Force Index is one of several oscillators that can work as the second screen of the triple screen trading system. Force Index marks buying opportunities when it falls below its center line. It marks selling opportunities when it rallies above its center line. When the weekly trend is up, take only buy signals from the daily oscillator for entering long positions. When the weekly trend is down, take only sell signals for entering short positions. At the right edge of the chart, the weekly trend has turned down. Wait for a rise in force index in order to sell short the center line. When the weekly trend is down, daily elder ray signals to go short when bull power rallies above zero and then ticks back down. Stochastic, see section 30, gives trading signals when its lines enter a buy or a sell zone. When weekly MACD histogram rises but daily stochastic falls below 30, it identifies an oversold area, a buying opportunity. When the weekly MACD histogram declines but daily stochastic rises above 70, it identifies an overbought area, a shorting opportunity. Williams percent R, see section 29, needs a 4 or 5-day window to work with. Triple screen. It is interpreted similarly to stochastic. The relative strength, 43. Triple screen trading system 241. Index does not react to price changes as fast as other oscillators. It helps with overall market analysis, but is too slow for triple screen. Third screen, intraday breakout. The first screen of the triple screen trading system identifies market tied on a weekly chart. The second screen identifies a wave that goes against that tide on a daily chart. The third screen identifies the ripples in the direction of the tide. It uses intraday price action to pinpoint entry points. The third screen does not require a chart or an indicator. It is a technique for entering the market after the first and second screens gave a signal to buy or sell short. The third screen is called a trailing buy-stop technique in uptrends and a trailing sell-stop technique in downtrends. Figure 43, 3. When the weekly trend is up and the daily trend is down, trailing buy stops catch upside breakouts. When the weekly trend is down and the daily trend is up, trailing sell stops catch downside breakouts. Triple screen summary. Weekly trend, daily trend action order. Up, stand aside, none. Up, down, go long, trailing buy stop. Down, down, stand aside, none. Down, up, go short, trailing sell stop. When a weekly trend is up and a daily oscillator declines, it activates a trailing buy stop technique. Place a buy order 1 tick above the high of the previous day. If prices rally, you will be stopped in long automatically when the rally takes out the previous day's high. If prices continue to decline, your buy stop will not be touched. Lower your buy order the next day to the level 1 tick above the latest price bar. Keep lowering your buy stop each day until stopped in or until the weekly indicator reverses and cancels its buy signal. When the weekly trend is down, wait for a rally in a daily oscillator to activate a trailing sell stop technique. Place an order to sell short 1 tick below the latest bar's low. As soon as the market turns down, you will be stopped in on the short side. If the rally continues, keep raising your sell order daily. The aim of a trailing sell stop technique is to catch an intraday Downside breakout from a daily uptrend in the direction of a weekly down. Trend. I asterisk KT. 8 asterisk LEE. 1. Force index slash. 2-day EMA slash. Weekly MAFPD sell. Weekly MACD buy. Figure 43, 3. Trailing buy stop. The third screen of triple. Screen. Weekly MACD histogram has turned up in mid-September. When the first screen points up, every decline of the second screen, the 2-day EMA. A force index marks a buying opportunity. A force index falls below its center line. Place a buy order for Tomer. Row 1 tick above the high of day A. B. The decline continues. Lower the buy order to 1 tick above the high of bar B. C. Bought at the opening. Place a stop at the low of bar B. The new high in force index shows that the rally is strong, likely to continue. D. Force index falls below its center line. Place a buy order at the bars. High. Bought when prices rallied above the high of D. Place a stop at the low of bar D. F. Force index falls below its center line. Place a buy order at the bars. High. G. Decline continues. Lower the buy stop to within 1 tick of the high of bar G. H. Bought when prices rallied above the high of G. Place a stop at the low of bar G. 1. Force index falls below its center line. Place a buy order at the bars. High. J. Decline continues. Lower the buy stop to within 1 tick of the high of bar J. K. Bought at the opening. Place a stop at the low of bar J. L. Cold opens lower and hits the protective stop. It is important to use stops because no indicator is perfect. 43. Triple screen trading system 243. Screen 3. Use the trailing buy stop technique when the weekly trend is up and the daily oscillator is down. Use the trailing sell stop technique when the weekly trend is down and the daily oscillator is up. Stop loss. Proper money management is essential for successful trading. A disciplined trader cuts his losses short and outperforms a loser who keeps hanging on and hoping. The triple screen trading system calls for placing very tight stops. As soon as you buy, place a stop loss order 1 tick below the low of the trade day or the previous day, whichever is lower. Once you sell short, place a protective stop loss 1 tick above the high of the trade day or the previous day, whichever is higher. Move your stop to a break-even level as soon as the market moves in your favor. Afterwards, the rule of thumb is to move your stop to protect approximately 50% of paper profits. See section 48. The reason for using such tight stops is that triple screen trades only in the direction of the tide. If a trade does not work out fast, it is a sign that something is fundamentally changing below the surface of the market. Then, it is better to run fast. The first loss is the best loss. It allows you to re-examine the market from the safety of the sidelines. Conservative traders should go long or short on the first signal of the triple screen trading system and stay with that position until the major trend reverses or until stopped out. Active traders can use each new signal from the daily oscillator for pyramiding the original position. A position trader should try and stay with a trade until the weekly trend reverses. A short-term trader may take profits using signals from the second screen. For example, if a trader is long and force index becomes positive or stochastic rises to 70%, he may sell and take profits, then look for another buying opportunity. The triple screen trading system combines different time frames and several types of indicators. It uses a trend-following indicator with the long-term charts and a short-term oscillator with the intermediate charts. It uses special entry techniques for buying or selling short. It also uses tight money management rules. 244 trading systems. 44. Parabolic trading system. The parabolic trading system was described in 1976 by J. Wells Wilder, Jr. It was named after the pattern of its stops during runaway moves, which resembled a parabola. The parabolic system is now included in many software packages. Parabolic aims to catch trends and to reverse positions when trends Reverse. Its unique feature is that it responds to the passage of time as well as to changing prices. Most traders focus on prices but ignore time. See Section 36. How to construct parabolic. Parabolic is a reversal system designed to keep a trader in the market all the time. When parabolic stops you out a long position, it tells you to go short at the same price. If it stops you out of a short position, it tells you to go long at the same price and time. This method worked well during the inflationary markets of the 1970s, but has led to many whipsaws in later years. Now, parabolic should be used selectively, only when markets are trending. Parabolic is based on a good old rule. Move your stops only in the direct tie into the trade and never against it. If you are long, you may raise your stops but never lower them. If you're short, you may only lower your stops. Parabolic stops are set daily using a formula. S2 tomorrow, SU, today, plus AF, E-trade, STOPEJ, caret J, where stop today equals the current stop. STO tomorrow equals the stop for the next trading day. E-trade equals the extreme point reached by the market in the current trade. If a trader is long, EP is the highest high reached since the day he bought. If a trader is short, EP is the lowest low reached since the day he went short. AF equals the acceleration factor. This unique tool determines how fast to move a stop in the direction of a trend. AF depends on the number of new highs since the entry into a long trade or the number of new lows since the entry into a short trade. On the first day in a trade, acceleration factor equals 0.02. This means that the stop is moved by 2% of the distance between the extreme point. 44. Parabolic trading system 245. And the original stop. AF increases by 0.02 each day the rally reaches a new high or decline reaches a new low, up to the maximum of 0.20. If the market reaches 3 higher highs during a long trade, AF equals 0.08. 0.02 plus 0.023. And if the market reaches 9 new highs, AF rises to its maximum of 0.20 or 0.02 plus 0.029. In the latter case, the daily stop gets moved by 20% of the distance between the extreme point of a trade and the latest stop. In the beginning of a trade, acceleration factor is small and stops move slowly. As the market reaches new highs or new lows, AF increases and stops move fast. If the market does not reach new highs or lows, AF keeps moving stops in the direction of the trade. By doing so, parabolic forces traders to get out of trades that go nowhere. Many traders change the acceleration factor. They adjust the size of the basic 0.02 step and the 0.20 maximum size of AF. Some increase them to make the system more sensitive. Others decrease them to make the system react slower. The size of a step often varies from 0.015 to 0.025 and a maximum size of AF from 0.18 to 0.23. Trading psychology. Losers go broke by hanging onto losing positions and hoping for a reversal. The parabolic system protects traders from indecision and imposes an iron discipline on them. It sets a stop the moment you enter a trade and tells you to move it in the direction of the trade. If you go long or short, but prices remain flat, it gives you a message that your timing was wrong. You would not have bought or shorted unless you expected prices to move right after you put on a trade. Parabolic does not let you hang onto a trade that goes nowhere. It moves stops in the direction of the trade, saying in effect, put up or shut up. The parabolic system is extremely useful during runaway trends. When prices soar or crash without a pullback, it is hard to place stops using normal chart patterns or indicators. Parabolic is the best tool for placing stops under those conditions. Trading rules. When you begin using parabolic in any given market, go back several weeks. To calculate its stops, adjust parabolic stops daily, with one exception. If it tells you to move the stop into the previous day's range. Don't do it. Stops should be kept outside of the previous day's range. 246 trading systems. 140, 135, 131, 126, 122, 117, 113, 108, 104, 100. Figure 44, 1. Parabolic system. Parabolic works well when the markets are moving, but not when the markets are flat. If you get whipsawed twice in a row, it signals a flat market. Stop using parabolic, but continue to track it on paper until you get two good signals. Parabolic shines in fast-moving markets. Here it took most of the profit out of a 30-plus point run in IBM and its subsequent decline with a single whipsaw in April. Two whipsaws in a row in May gave a signal to stop using parabolic. The parabolic system works well in trending markets, but leads to whip saws in trendless markets. It can generate spectacular profits during price trends, but chop up an account in a trading range. Do not use it as an automatic trading method. The original parabolic was a true reversal system. When a trader was long one contract, it told him a place in order to sell two contracts if his stop was hit. Then he sold his long position and automatically went short. When a trader was short one contract, parabolic told him to place an order to buy two if his stop was hit. Then he covered his short position and went long. A trader is better off entering the market using some other trading method, such as the triple screen trading system, and then switching to 45. Channel trading systems 247. Parabolic only if he finds himself riding a dynamic uptrend or a downtrend. Figure 44 1. 1. When you find yourself in a strong uptrend, go over the past several weeks of data and apply the parabolic system. Having updated parabolic to the current day, begin calculating stops daily and use them to protect profits on your long position. 2. When you find yourself short in a fast downtrend, apply parabolic to the past several weeks of data and update it to the present day. From that day on, calculated stops daily to protect profits on your short position. The parabolic system ties together price and time and moves stops in the direction of the trade. The faster the trend, the faster parabolic moves its stops. Parabolic is an excellent tool for getting the most out of a strong trend that was entered using any method. 45. Channel trading systems. Prices often flow in channels, the way rivers flow in valleys. When a river touches the right edge of its valley, it turns left. When a river touches the left rim of its valley, it turns right. When prices rally, they often seem to stop at an invisible ceiling. When they fall, they often seem to hit an invisible floor. Channels help traders identify buying and selling opportunities and avoid bad trades. The original research into trading channels was conducted by J. M. Hurst and described in his 1970 book, The Profit Magic of Stock. Transaction timing. 4 ways to construct a channel. Channels help traders because their boundaries show where to expect support or resistance to come into the market. There are 4 main ways to construct a channel. 1. By drawing a channel line parallel to a trend line. See section 21. 2. By plotting 2 lines parallel to a moving average, one above it and another below. 248 trading systems. 3. Same as above, only the distance between each line and the moving average changes depending on the market's volatility, Bollinger Bands. 4. By drawing a moving average of the highs and another of the lows. Channels parallel to trend lines are useful for long-term analysis, especially on the weekly charts. Channels around moving averages are useful for short-term analysis, especially on daily and intraday charts. Channels whose width depends on volatility are good for catching early stages of major new trends. Support is where buyers buy with greater intensity than sellers sell. Resistance is where sellers sell with greater intensity than buyers buy. See Section 19. Channels show where to expect support and resistance in the future. A channel slope identifies a market's trend. When a channel lies flat, you may trade all swings within its walls. When a channel rises, it pays to trade only from the long side, buying at the lower wall and selling at the upper wall. When a channel declines, it pays to trade only from the short side, shorting at the upper channel wall and covering at the lower wall. Moving average channels. A 13-day exponential moving average can serve as the backbone of a chart. Now, see section 25. Draw upper and lower channel lines parallel to it. The width of a channel depends on the coefficient selected by the trader. Upper channel line equals EMA plus channel coefficient, EMA. Lower channel line equals EMA, channel coefficient, EMA. You need to adjust channel coefficients until a channel contains 90% to 95% of the price action. A channel shows the boundaries between normal and abnormal price action. It is normal for prices to be inside a channel, and only unusual events push them outside. The market is undervalued below its lower channel line and overvalued above its upper channel line. For example, in 1992, the channel coefficient on the daily chart of the S&P 500 futures was 1.5%. If the 13-day EMA stood at 400, then the upper channel line was 406, 400 plus, 400, 1.5/100, and the lower channel line was 394, 400, 400, 1.5/100. 248 trading systems. 3. Same as above, only the distance between each line and the moving average changes depending on the market's volatility, Bollinger Bands. 4. By drawing a moving average of the highs and another of the lows. Channels parallel to trend lines are useful for long-term analysis, especially on the weekly charts. Channels around moving averages are useful for short-term analysis, especially on daily and intraday charts. Channels whose width depends on volatility are good for catching early stages of major new trends. Support is where buyers buy with greater intensity than sellers sell. Resistance is where sellers sell with greater intensity than buyers buy. See Section 19. Channels show where to expect support and resistance in the future. A channel's slope identifies a market's trend. When a channel lies flat, you may trade all swings within its walls. When a channel rises, it pays to trade only from the long side, buying at the lower wall and selling at the upper wall. When a channel declines, it pays to trade only from the short side, shorting at the upper channel wall and covering at the lower wall. Moving average channels. A 13-day exponential moving average can serve as the backbone of a chart. Now, see section 25. Draw upper and lower channel lines parallel to it. The width of a channel depends on the coefficient selected by the trader. Upper channel line equals EMA plus channel coefficient, EMA. Lower channel line equals EMA, channel coefficient, EMA. You need to adjust channel coefficients until a channel contains 90% to 95% of the price action. A channel shows the boundaries between normal and abnormal price action. It is normal for prices to be inside a channel, and only unusual events push them outside. The market is undervalued below its lower channel line and overvalued above its upper channel line. For example, in 1992, the channel coefficient on the daily chart of the S&P 500 futures was 1.5%. If the 13-day EMA stood at 400, then the upper channel line was 406, 400 plus, 400, 1.5/100, and the lower channel line was 394, 400, 400, 1.5/100. 248 trading systems. 3. Same as above, only the distance between each line and the moving average changes depending on the market's volatility, Bollinger Bands. 4. By drawing a moving average of the highs and another of the lows. Channels parallel to trend lines are useful for long-term analysis, especially on the weekly charts. Channels around moving averages are useful for short-term analysis, especially on daily and intraday charts. Channels whose width depends on volatility are good for catching early stages of major new trends. Support is where buyers buy with greater intensity than sellers sell. Resistance is where sellers sell with greater intensity than buyers buy. See Section 19. Channels show where to expect support and resistance in the future. A channel slope identifies a market's trend. When a channel lies flat, you may trade all swings within its walls. When a channel rises, it pays to trade only from the long side, buying at the lower wall and selling at the upper wall. When a channel declines, it pays to trade only from the short side, shorting at the upper channel wall and covering at the lower wall. Moving average channels. A 13-day exponential moving average can serve as the backbone of a channel. See Section 25. Draw upper and lower channel lines parallel to it. The width of a channel depends on the coefficient selected by the trader. Upper channel line equals EMA plus channel coefficient EMA. Lower channel line equals EMA, channel coefficient EMA. You need to adjust channel coefficients until a channel contains 90% to 95% of the price action. A channel shows the boundaries between normal and abnormal price action. It is normal for prices to be inside a channel, and only unusual events push them outside. The market is undervalued below its lower channel line and overvalued above its upper channel line. For example, in 1992, the channel coefficient on the daily chart of the S&P 500 futures was 1.5%. If the 13-day EMA stood at 400, then the upper channel line was 406, 400 plus, 400, 1.5/100, and the lower channel line was 394, 400, 400, 1.5/100. 45. Channel trading systems 249. Adjust channel coefficients at least once every 3 months to make a channel contain 90% to 95% of prices. If prices keep blowing out of a channel and staying outside for more than a few days, that channel should be widened. Too many reversals within the channel without reaching its walls indicate falling volatility, and that channel should be tightened. Volatile markets require wider channels, and quieter markets require NAR. Row channels. Long-term charts require wider channels. As a rule of thumb, weekly channel coefficients are twice as wide as daily ones. Mass psychology. An exponential moving average reflects the average consensus of value during the time covered by that average. See Section 25. When prices rise above the average consensus of value, sellers see an opportunity to take profits on long positions or go short. When they overpower the bulls, prices decline. When prices fall below the moving average, bargain hunters step in. They're buying and short covering by bears lift prices, and the cycle repeats. When prices are near their moving average, the market is fairly valued. When prices are at or below the lower channel line, the market is undervalued. When prices are at or above the upper channel line, the market is overvalued. Channels help traders find buying opportunities when the market is cheap and shorting opportunities when the market is dear. The market is like a manic depressive person. When he reaches the height of mania, he is ready to calm down, and when he reaches the bottom of his depression, his mood is ready to improve. A channel marks the limits of mass optimism and pessimism. Its upper line shows where bulls emit out of steam, and its lower line shows where bears become exhausted. Every animal fights harder closer to home. The upper channel line shows where bears have their backs against the wall and fight off the bulls. The lower channel line shows where bulls have their backs against the wall and fight off the bears. Where a rally fails to reach the upper channel line, it is a bearish sign. It shows that bulls are becoming weaker. If a rally shoots out of a channel and prices close above it, it shows that the uptrend is strong. The reverse rules apply in downtrends. Channels help traders who use them remain objective when others get swept up in bullish or bearish hysteria. If prices touch the upper channel line, 250 trading systems. You see that mass bullishness is being overdone and it is time to think about selling. When everyone turns bearish, but prices touch the lower channel line, you know that it is time to think about buying instead of selling. Trading rules. Amateurs and market professionals handle channels differently. Amateurs bet on long shots. They tend to buy upside breakouts and sell short down. Side breakouts. When an amateur sees a breakout from a channel, he hopes that a major new trend is about to begin and make him rich quick. Professionals trade against deviations and for a return to normalcy. It is normal for prices to remain within channels. Most breakouts are exhaustion, moves that are quickly aborted. Professionals like to fade them, trade against them. They sell short as soon as an upside breakout stalls and buy when a downside breakout stops reaching new lows. Breakouts can produce spectacular gains for amateurs when a major new trend blows out of a channel. Amateurs occasionally win, but it pays to trade with the professionals. Most breakouts are false and are followed by reversals. Moving average channels can be used as a standalone trading method or combined with other techniques. Gerald Appel has recommended the follow. ING rules for trading with channels. 1. Draw a moving average and build a channel around it. When a channel is relatively flat, the market is almost always a good buy near the bottom of its trading channel and a good sell near the top. 2. When the trend turns up and a channel rises sharply, an upside peen. Traction of the upper channel line shows very strong bullish momentum. It indicates that you will probably have one more chance to sell in the area of the highs that are being made. It is normal for the market to return to its moving average after an upside penetration, offering an excellent buying opportunity. Sell your long position when the market returns to the top of the channel. 3. The above rule works in reverse during sharp downtrends. A breakout below the lower channel boundary indicates that a pullback to the moving average is likely to occur, offering another opportunity to sell short. When prices return to the lower channel line, it is time to cover shorts. 45. Channel trading systems 251. The best trading signals are given by a combination of channels and technical indicators. Indicators give their strongest signals when they diverge from prices. See Figure 45.1. A method for combining channels and divergences has been described by Manning Stoller in an interview with this author. 4. A sell signal is given when prices reach the upper channel line while an indicator, such as stochastic or MACD histogram, traces a lower top and creates a bearish divergence. It shows that bulls are becoming weak when prices are overextended. 5. A buy signal is given when prices reach the lower channel line while an indicator traces a higher bottom and creates a bullish divergence. It shows that bears are becoming weak when prices are already low. We must analyze markets in more than one time frame. Go long when prices are rising from the bottom to the top of the channel on both weekly and daily charts. Sell short when prices are sinking from the top to the bottom of the channel on both weekly and daily charts. 6. Go long below the moving average when the channel is rising and take profits at the upper channel line. Go short when the channel is falling and take profits at the lower channel line. Standard deviation channels, Bollinger Bands. Standard deviation channels have been proposed by Perry Kaufman in his book, The New Commodity Trading Systems and Methods, and popularized by analyst John Bollinger. The unique feature of Bollinger Bands is that they're with changes in response to market volatility. Trading rules for them differ from those for other channels. 1. Calculate a 21-day EMA. 2. Subtract the 21-day EMA from each closing price to obtain all the deviations from the average. 3. Square each of the deviations and get their sum to obtain the total squared deviation. 4. Divide the total squared deviation by the EMA length to obtain the average squared deviation. 252 trading systems. Figure 45.1. Trading with channels and indicators. A moving average reflects the average consensus of value. A channel, or An envelope must be adjusted until it contains 90%, 95% of all data. The upper channel line shows where the market is overvalued. The lower channel line shows where it is undervalued. It pays to buy in the lower half of a rising channel and to sell short in the upper half of a falling channel. Channels work best when their signals are combined with indicator divergences. Bullish divergences in July and October occurred when the Swiss franc was undervalued near its lower channel line. These buy signals led to strong rallies. Bearish divergences occurred in August and November when the Swiss franc was overvalued near its upper channel line. These sell signals were followed by sharp breaks. Combining channels with divergences allows you to trade against the market crowd at key turning points. 5. Take the square root of the average square deviation to obtain the standard deviation. These steps, outlined by John Bollinger, can be performed by many software packages for technical analysis. A Bollinger Band becomes wider when volatility increases and narrows down when it decreases. A narrow Bollinger. 45. Channel Trading Systems 253. Band identifies a sleepy, quiet market. Major market moves tend to erupt from flat bases. Bollinger Bands help find transitions from quiet to active markets. When prices rally outside a very narrow Bollinger Band, they give a buy signal. When they drop out of a very narrow Bollinger Band, they give a SIG, an AL to go short. When prices pull back to their channel from the outside, it is time to close out positions. Bollinger Bands are especially useful for options traders. Options prices depend heavily on the swings in volatility. Bollinger Bands help you buy when volatility is low and options are relatively cheap. They help you sell options when volatility is high and options are expensive. More on channels. Some traders use channels whose upper line is a moving average of the highs and whose lower line is a moving average of the lows. They appear more ragged than other channels. A trader has to choose a smoothing period for these channels. Here, as elsewhere, a 13-day EMA is a safe bet. A 13-day EMA of the highs creates the upper channel line, and a 13-day EMA of the lows creates the lower channel line. One of the popular technical indicators is the commodity channel index, CCI. It is based on the same principles as channels. It measures deviations from the moving average. If you use channels in trading, you may dispense with the CCI. Channels are better because they keep you visually closer to prices. X. Risk management. 46. Emotions and probabilities. Trading is so exciting that it often makes amateurs feel high. A trade for them is like a ticket to a movie or a professional ball game. Trading is a much more expensive entertainment than the cinema. Nobody can get high and make money at the same time. Emotional trad. ING is the enemy of success. Greed and fear are bound to destroy a trader. You need to use your intellect instead of trading on gut feeling. A trader who gets giddy from profits is like a lawyer who starts counting cash in the middle of a trial. A trader who gets upset at losses is like a Sir Gian who faints at the sight of blood. A real professional does not get too excited about wins or losses. The goal of a successful professional in any field is to reach his personal best, to become the best doctor, the best lawyer, or the best trader. Money flows to them almost as an afterthought. You need to concentrate on trading, right, and not on the money. Each trade has to be handled like a surgical procedure, seriously, soberly, without sloppiness or shortcuts. Why Johnny can't sell. A loser cannot cut his losses quickly. When a trade starts going sour, he hopes and hangs on. He feels that he cannot afford to get out, meets his mar. 254. 46. Emotions and probabilities 255. Jin calls and keeps hoping for reversal. His paper loss grows until what seemed like a bad loss starts looking like a bargain. Finally, his broker forces him to bite the bullet and take his punishment. As soon as he gets out of a trade, the market comes roaring back. The loser is ready to smash his head against the wall. Had he hung on, he would have made a small fortune on the reversal. Trends reverse when they do because most losers are alike. They act on their gut feelings instead of using their heads. The emotions of people are similar, regardless of their cultural backgrounds or educational levels. A frightened trader with sweaty palms and a pounding heart feels the same whether he grew up in New York or Hong Kong and whether he had 2 years or 20 years of schooling. Roy Shapiro, a New York psychologist from whose article this subtitle is borrowed, writes, "With great hope, in the private place where we make our trading decisions, our current idea is made ready. One difficulty in selling is the attachment experience toward the position. After all, once something is ours, we naturally tend to become attached to it. This attachment to the things we buy has been called the endowment effect by psychologists and economists, and we all recognize it in our financial transactions as well as in our inability to part with that old sports jacket hanging in the closet. The speculator is the parent of the idea. The position takes on meaning as a personal extension of self, almost as one's child might. Another REA, son that Johnny does not sell, even when the position may be losing ground, is because he wants to dream. For many, at the moment of purchase critical, judgment weakens and hope ascends to govern the decision process. Dreaming in the markets is a luxury that nobody can afford. If your trades are based on dreams, you're better off putting your money into psychotherapy. Dr. Shapiro describes a test that shows how people conduct business, involving a chance. First, a group of people are given a choice, a 75% chance to win $1,000 with a 25% chance of getting nothing or a sure $700. 4 out of 5 subjects take the second choice, even after it is explained to them that the first choice leads to a $750 gain over time. The majority makes the emotional decision and settles for a smaller gain. Another test is given. People have to choose between a sure loss of $700 or a 75% chance of losing $1,000 and a 25% chance of losing nothing. 3 out of 4 take the second choice, condemning themselves to lose $50 more than they have to. And try to avoid risk, they maximize losses. X. Risk management. 46. Emotions and probabilities. Trading is so exciting that it often makes amateurs feel high. A trade for them is like a ticket to a movie or a professional ball game. Trading is a much more expensive entertainment than the cinema. Nobody can get high and make money at the same time. Emotional trad. ING is the enemy of success. Greed and fear are bound to destroy a trader. You need to use your intellect instead of trading on gut feeling. A trader who gets giddy from profits is like a lawyer who starts counting cash in the middle of a trial. A trader who gets upset at losses is like a Sir Gian who faints at the sight of blood. A real professional does not get too excited about wins or losses. The goal of a successful professional in any field is to reach his personal best, to become the best doctor, the best lawyer, or the best trader. Money flows to them almost as an afterthought. You need to concentrate on trading, right, and not on the money. Each trade has to be handled like a surgical procedure, seriously, soberly, without sloppiness or shortcuts. Why Johnny can't sell. A loser cannot cut his losses quickly. When a trade starts going sour, he hopes and hangs on. He feels that he cannot afford to get out. Meets his mar. 254. 46. Emotions and probabilities. 255. Jin calls and keeps hoping for reversal. His paper loss grows until what seemed like a bad loss starts looking like a bargain. Finally, his broker forces him to bite the bullet and take his punishment. As soon as he gets out of a trade, the market comes roaring back. The loser is ready to smash his head against the wall. Had he hung on, he would have made a small fortune on the reversal. Trends reverse when they do because most losers are alike. They act on their gut feelings instead of using their heads. The emotions of people are similar, regardless of their cultural backgrounds or educational levels. A frightened trader with sweaty palms, and a pounding heart feels the same whether he grew up in New York or Hong Kong, and whether he had 2 years or 20 years of schooling. Roy Shapiro, a New York psychologist from whose article this subtitle is borrowed, writes, "With great hope, in the private place where we make our trading decisions, our current idea is made ready. One difficulty in selling is the attachment experience toward the position. After all, once something is ours, we naturally tend to become attached to it. This attachment to the things we buy has been called the endowment effect by psychologists and economists, and we all recognize it in our financial transactions as well as in our inability to part with that old sports jacket hanging in the closet. The speculator is the parent of the idea. The position takes on meaning as a personal extension of self, almost as one's child might. Another REA, son that Johnny does not sell, even when the position may be losing ground, is because he wants a dream. For many, at the moment of purchase critical, judgment weakens and hope ascends to govern the decision process. Dreaming in the markets is a luxury that nobody can afford. If your trades are based on dreams, you are better off putting your money into psychotherapy. Dr. Shapiro describes a test that shows how people conduct business, involving a chance. First, a group of people are given a choice, a 75% chance to win $1,000 with a 25% chance of getting nothing, or a sure $700. 4 out of 5 subjects take the second choice, even after it is explained to them that the first choice leads to a $750 gain over time. The majority makes the emotional decision and settles for a smaller gain. Another test is given. People have to choose between a sure loss of $700 or a 75% chance of losing $1,000 and a 25% chance of losing nothing. 3 out of 4 take the second choice, condemning themselves to lose $50 more than they have to. In trying to avoid risk, they maximize losses. 256. Risk management. Emotional traders want certain gains and turn down profitable wagers that involve uncertainty. They go into risky gambles to avoid taking certain losses. It is human nature to take profits quickly and postpone taking losses. Irrational behavior increases when people feel under pressure. According to Dr. Shapiro, bets on long shots increase in the last 2 races of the day. Emotional trading destroys losers. If you review your trading records, you will see that the real damage to your account was done by a few large losses, or by long strings of losses while trying to trade your way out of a hole. Good money management would have kept you out of the hole in the first place. Probability and innumeracy. Losing traders look for a sure thing, hang on to hope, and irrationally avoid accepting small losses. Their trading is based on emotions. Losers do not understand the key concepts of probability. They have no grasp of odds or random processes and have many superstitions about them. Innumeracy, not knowing the basic notions of probability, chance, and randomness, is a fatal intellectual weakness in traders. Those simple ideas can be learned from many basic books. The lively book Innumeracy by John Allen Paulos is an excellent primer on the concepts of probability. Paulos describes being told by a seemingly intelligent person at a cocktail party, if the chance of rain is 50% on Saturday and 50% on Sunday, then it is 100% certain it will be a rainy weekend. Someone who understands so little about probability is sure to lose money trading. You owe it to yourself to develop a basic grasp of mathematical concepts involved in trading. Ralph Vince begins his important book, Portfolio Management Formulas, with a delightful paragraph: toss a coin in the air. For an instant you expiry. It's one of the most fascinating paradoxes of nature, the random process. While the coin is in the air, there is no way to tell for certain whether it will land heads or tails. Yet over many tosses the outcome can be reasonably predicted. Mathematical expectation is an important concept for traders. It is called the player's edge, a positive expectation, or the house advantage, a negative expectation. depending on who the odds in a game favor. If you and I flip a coin, neither of us has an edge. Each has a 50% chance of winning. But if you flip a coin in a casino that schemes 10% from every pot, you will win only 90 cents for every dollar you lose. This house advantage air, 47. Money management, 257. Atesh, a negative mathematical expectation for you. No system for money management can beat a negative expectation game over a period of time. A positive expectation. If you know how to count cards in blackjack, you can have an edge against a casino, unless they detect you and throw you out. Casinos love drunk gamblers but hate card counters. An edge lets you win more often than you lose. Over a period of time, good money management can help you make more money from your edge and minimize losses. Without an edge, you might as well give money to charity. In trading, the edge comes from a system that delivers greater profits than losses, slippage, and commissions. No money management method can rescue a bad trading system. You can win only if you trade with a positive mathematical expectation. A sensible trading system. Trading on hunches leads to disasters. Many traders act like drunks wandering through a casino, going from game to game. Slippage and commissions destroy those who overtrade. The best trading systems are crude and robust. They are made of a few elements. The more complex the systems, the more elements that can break. Traders love to optimize their systems using past data. The trouble is your broker won't let you trade the past. Markets change, and the ideal parameters from the past may be no good today. Try to de-optimize your system. Instead, check how it would have performed under bad conditions. A robust system holds up well when markets change. It is likely to beat a heavily my system in real-world trading. Finally, when you develop a good system, don't mess with it. Design another one if you like to tinker. As Robert Prechter put it, most traders take a good system and destroy it by trying to make it into a perfect system. Once you have your trading system, it is time to set the rules for money management. 47. Money management. Suppose you and I bet a penny on a coin flip. Tails, you win. Heads, you lose. Suppose you have $10 of risk capital and I have $1. Even though I have less money, I have little to fear. It would take a string of 100 losses to wipe me out. We can play for a long time, unless two brokers get between us and drain our capital by commissions and slippage. 258. Risk management. The odds will dramatically change if you and I raise our bet to a quarter. If I have only $1, then a string of only 4 losses will destroy me. If you have $10, you can afford to lose a quarter 40 times in a row. A series of 4 losses is likely to come much sooner than 40. All other factors being equal, the poorer of 2 traders is the first to go broke. Most amateurs think that other factors are far from equal. They consider themselves brighter than the rest of us. The trading industry works hard to reinforce that delusion, telling traders that winners get the money lost by losers. They try to hide the fact that trading is a minus-sum game. See Section 3. Cocky amateurs take wild risks, producing commissions for brokers and profits for floor traders. When they blow themselves out of the market, new suckers come in because hope springs eternal. Survival first. The first goal of money management is to ensure survival. You need to avoid risks that can put you out of business. The second goal is to earn a steady rate of return, and the third goal is to earn high returns, but survival comes first. Do not risk thy whole wad is the first rule of trading. Losers violate it by betting too much on a single trade. They continue to trade the same or even a bigger size during a losing streak. Most losers go bust trying to trade their way out of a hole. Good money management can keep you out of the hole in the first place. The deeper you fall, the more slippery your hole. If you lose 10%, you need to gain 11% to recoup that loss. But if you lose 20%, you need to gain 25% to come back. If you lose 40%, you need to make a whopping 67%. And if you lose 50%, you need to make 100% simply to recover. While losses grow arithmetically, the profits that are required to recoup them increase geometrically. You have to know in advance how much you can lose, when and at what level you will cut your loss. Professionals tend to run as soon as they smell trouble and re-enter the market when they see fit. Amateurs hang on and hope. Get rich slowly. An amateur trying to get rich quick is like a monkey out on a thin branch. He reaches for a ripe fruit but crashes when the branch breaks under his weight. 47. Money Management 259. Institutional traders as a group tend to be more successful than private traders. They owe it to their bosses who enforce discipline. See Section 14. If a trader loses more than his limit on a single trade, he is fired for insubordination. If he loses his monthly limit, his trading privileges are suspended for the rest of the month, and he becomes a gopher, fetching other traders' cough. Fee. If he loses his monthly limit several times in a row, the company either fires or transfers him. This system makes institutional traders avoid losses. Private traders have to be their own enforcers. An amateur who opens a $20,000 trading account and expects to run it into $1 million in 2 years is like a teenager who runs away to Hollywood to become a pop singer. He may succeed, but the exceptions only confirm the rule. Amateurs try to get rich quick, but destroy themselves by taking wild risks. They may succeed for a while, but hang themselves given enough rope. Amateurs often ask me what percentage profit they can make annually from trading. The answer depends on their skills or lack of such a market conditions. Amateurs never ask a more important question: how much will I lose before I stop trading and reevaluate myself, my system, and the markets? If you focus on handling losses, profits will take care of themselves. A person who makes 25% profit annually is a king of Wall Street. Many top-flight money managers would give away their firstborn child to be able to top this. A trader who can double his money in a year is a star, as rare as a pop musician or a top athlete. If you set modest goals for yourself and achieve them, you can go very far. If you can make 30% annually, people will beg you to manage their money. If you manage $10 million, not an outlandish amount in today's markets, your management fee alone can run 6% of that, or $600,000 a year. If you make a 30% profit, you will keep 15% of it as an incentive fee, another $450,000. You will earn over $1 million a year trading without taking big risks. Keep these numbers in mind when you plan your next trade. Trade to establish the best track record with steady gains and small drawdowns. How much to risk? Most traders get killed by one of two bullets: ignorance or emotion. Amateurs act on hunches and stumble into trades that they should never take due to negative mathematical expectations. Those who survive the stage of virginal ignorance go on to design better systems. When they become more 260 risk management confident, they lift their heads out of the foxholes and the second bullet hits them. Confidence makes them greedy. They risk too much money on a trade, and a short string of losses blows them out of the market. If you bet a quarter of your account on each trade, your ruin is guaranteed. You will be wiped out by a very short losing streak, which happens even with excellent trading systems. Even if you bet a tenth of your account on a trade, you will not survive much longer. A professional cannot afford to lose more than a tiny percentage of his equity on a single trade. An amateur has the same attitude toward trading as an alcoholic has toward drinking. He sets out to have a good time, but wins up destroying himself. Extensive testing has shown that the maximum amount a trader may lose on a single trade without damaging his long-term prospects is 2% of his equity. This limit includes slippage and commissions. If you have a $20,000 account, you may not risk more than $400 on any trade. If you have a $100,000 account, you may not risk more $2,000 on a trade, but if you have only $10,000 in your account, then you can risk no more than $200 on a trade. Most amateurs shake their heads when they hear this. Many have small accounts, and the 2% rule throws a monkey wrench into the dreams of quick profits. Most successful professionals, on the other hand, consider the 2% limit too high. They do not allow themselves to risk more than 1% or 1.5% of their equity on any single trade. The 2% MLE puts a solid floor under the amount of damage the market can do to your account. Even a string of 5 or 6 losing trades will not cripple your prospects. In any case, if you're trading to create the best track record, you'll not want to show more than 6% or 8% monthly loss. When you hit that limit, stop trading for the rest of the month. Use this cooling off period to re-examine yourself, your methods, and the markets. The 2% rule keeps you out of riskier trades. When your system gives an entry signal, check to see where to place a logical stop. If that would expose more than 2% of your account equity, pass up that trade. It pays to wait for trades that allow very close stops. See Chapter 9. Waiting for them reduces the excitement of trading, but enhances profit potential. You choose which of the two you really want. The 2% rule helps you decide how many contracts to trade. For example, if you have $20,000 in your account, you may risk up to $400 per trade. If your system flags an attractive trade with a $275 risk, then you may trade only one contract. If the risk is only $175, then you can afford to trade two contracts. 47. Money management 261. What about pyramiding? Increasing the size of your trading positions as a trade moves in your favor? The 2% rule helps here too. If you show profit on a trend-following position, you may add to it, as long as your existing position is at a break-even level or better and the risk on the final position does not exceed 2% of your equity. Martingale systems. Once you set your maximum risk per trade, you have to decide whether to risk the same amount on every trade. Most systems vary the amount of money at risk from trade to trade. One of the oldest money management systems is the martingale, originally developed for gambling. It has you bet a greater amount after a loss in order to come back. Needless to say, this approach has a great emotional appeal to losers. A martingale player in a casino keeps betting $1 as long as he wins, but if he loses, he doubles up and bets $2. If he wins, he ends up with a $1 profit, minus $1 plus $2, and goes back to betting $1. If he loses, he doubles up again and bets $4. If he wins, he gets a $1 profit, minus $1, minus $2 plus $4. But if he loses, he doubles up and bets $8. As long as he keeps doubling up, his very first win will cover all his losses and return a profit equal to his original bet. A martingale system sounds like a no-lose proposition until you realize that a long run of bad trades will wipe out every gambler, no matter how rich. At the extreme, a gambler who starts betting $1 and has 46 losses in a row has to bet $70 trillion on his 47th bet, more than the net worth of the entire world, about $50 trillion. He is sure to run out of money or hit the house limit much sooner than that. A martingale system is futile if you have a negative or even money expectation. It is self-defeating if you have a winning system and a positive expectation. Amateurs love martingale systems because of their emotional appeal. There's a common superstition that you can get unlucky only up to a point, and that bad luck is bound to change. Losers often trade more heavily after a drawdown. A loser fighting to come back often doubles his trading size after a loss. This is a very poor method of money management. If you want to vary your trading size, logic requires you to trade more when your system is in gear with the market and making money. As your account grows, the 2% rule allows you to trade larger amounts. You should trade less when your system is out of sync with the market and losing money. 262. Risk management. Optimal F. Some traders who develop computerized trading systems believe in trading what they call the optimal / an optimal fixed fraction of the account. The fraction of capital they risk on any trade depends on a formula that is based on the performance of their trading system and their account size. It is a complex method, but whether you use it or not, you can borrow several sound ideas from it. Ralph Vince has shown in his book, Portfolio Management Formulas, that 1. Optimal slash keeps changing. 2. If you trade more than optimal slash, you gain no benefit and are virtually certain to go broke. 3. If you trade less than optimal slash, your risk decreases arithmetically, but your profits decrease geometrically. Trading at the optimal slash is emotionally hard because it can lead to 85% drawdowns. It should be attempted only with true risk capital. The key point here is that if you trade more than the optimal fraction, you are certain to destroy your account. The lesson is, when in doubt, risk less. Computerized testing of money management rules has confirmed several old-timers' rules and observations. The true measure of any system's financial risk is its biggest losing trade. A drawdown depends on the length of an adverse run, which can never be predicted. Diversification can buffer the drawdowns. You can diversify by trading different markets and using different systems. Closely related markets, such as currencies, offer no diversifica. Tie-in. A small trader is forced to follow a simple rule. Put all your eggs into one basket and watch it like a hawk. According to Vince, computer testing has proven several common money management rules. Never average down. Never meet a margin call. If you must lighten up, liquidate your worst position. The first mistake is the cheapest. Reinvesting profits. Pay attention to what you feel when you handle profits. Many traders feel torn between a craving for a bigger and faster buck and a fear of losing. A professional trader calmly removes some money from his account, just as any other professional draws an income from his work. An amateur who fearfully grabs a profit and buys something with it before he can lose it shows little confidence in his ability to make money. Reinvesting can turn a winning system into a losing one, but no method of. 48. Exiting trades. 263. Reinvesting profits can turn a losing system into a winning one. Leaving profits in your account allows you to make money faster by trading more contracts or being able to establish long-term positions using wider stops. Removing some of your profits provides a cash flow. The government also wants its share in taxes. There is no hard and fast rule for splitting your profits between reinvestment and personal use. It depends on your personality and the size of your trading account. If you start with a small account, such as $50,000, you will not want to drain profits from it. When your account is well into six figures, you may begin treating it as an income-producing business. You will need to make important personal decisions. Do you need $30,000 or $300,000 a year to live on? Are you willing to cut spending in order to leave more in your account? The answers to these questions depend on your personality. Make sure to use your intellect and not your emotions when you make these decisions. 48. Exiting trades. Taking a loss can be emotionally hard, but taking a profit can be even harder. You can take a small loss automatically if you have the discipline to set a stop the moment you enter a trade. Taking a profit requires more thought. When a market moves in your favor, you need to decide whether to stay put, get out, or add to your position. An amateur can tie his mind into a not trying to decide what to do about a profit. He multiplies the number of ticks by their dollar value and feels a surge of greed. Let the trade run, make even more money. Then the market ticks against him, and he is hit with a jolt of fear. Grab that profit now, before it melts. A trader who acts on his emotions cannot make rational decisions. One of the worst mistakes of traders is counting money while they have an open position. Counting money ties your mind into a knot. It interferes with your ability to trade rationally. If you catch yourself counting paper profits and thinking what you can buy with them, get rid of those thoughts. If you cannot get rid of them, get rid of your position. If a beginner cashes out too early, he kicks himself for leaving money on the table. He decides to hang on the next time, overstays a trade, and loses money. If a beginner misses a profit because of a reversal, he grabs the first profit on the next trade and may well miss a major move. The market tugs on the amateur's emotions, and he jerks in response. 264 Risk management. A trader who responds to his feelings instead of external reality is certain to lose. He may grab a profit here and there, but will eventually bust out, even if his system gives him good trades. Greed and fear destroy traders by clouding their minds. The only way to succeed in trading is to use your intellect. Quality before money. The goal of a successful trader is to make the best trades. Money is secondary. If this surprises you, think how good professionals in any field operate. Good teachers, doctors, lawyers, farmers, and others make money, but they do not count it while they work. If they do, the quality of their work suffers. If you ask your doctor how much money he earned today, he won't be able to answer. And if he can, you do not want him for a doctor. Ask your lawyer how much money he made today. He may have a general idea that he put in some billable hours, but not exactly how many dollars he made. If he counts money while he works, you do not want him for a lawyer. A real pro devotes all his energy to practicing his craft the best he can, not to counting money. Counting money in a trade flashes a red light, a warning that you are about to lose because your emotions are kicking in and they will override your intellect. That is why it is a good idea to get out of a trade if you cannot. Get money off your mind. Concentrate on quality, on finding trades that make sense, and having a money management plan that puts you in control. Focus on finding good entry points and avoid gambles. Then the money will follow almost as an afterthought. You may count it later, well after a trade is over. A good trader must focus on finding and completing good trades. A professional always studies the markets, looks for opportunities, hones his money management skills, and so on. If you ask him how much money he made on the current trade, he will have only a general idea of being a little or a lot ahead of the game or a little behind. He can never be a lot behind. Because of tight stops, like other professionals, he focuses on practicing his craft and polishing his skills. He does not count money in a trade. He knows that he will make money as long as he does what is right in the markets. Indicator signals. If you use indicators for finding trades, use them also to get you out of trades. If your indicators are in gear with the market when it is time to buy or go short, use them to decide when it is time to sell or to cover. 48. Exiting trades. 265. A trader often becomes emotionally attached to a trade. Profits give PLE a high, but even a loss can tingle the nerves like a scary but exciting ride on a roller coaster. When those indicator signals that flagged a trade to sap, get out of the market fast, regardless of your feelings. For example, you may go long because a 13-week EMA has ticked up on the weekly charts while daily stochastic fell into its buy zone. If you go long, decide in advance whether you will sell when daily stochastic rallies and becomes overbought or when the 13-week EMA turns down. Write down your plan and keep it where you can always see it. You may go short because weekly MACD histogram ticked down and daily elder gave a sell signal. Decide in advance whether you will cover when daily elder give a buy signal or when weekly MACD histogram turns up. You need to decide in advance which signals you will take. There will be many signals, and the best time to decide is before you enter a trade. Profit targets, Elliott, and Fibonacci. Some traders try to establish profit targets. They want to sell strength when prices hit resistance or buy weakness when prices reach support. Elliott. Wave theory is the main method for trying to forecast reversal points. Elliott wrote several articles about the stock market and a book, Nature's Law. He believed that every movement in the stock market could be broken into waves, smaller waves, and subwaves. Those waves explained every turning point and occasionally allowed him to make correct predictions. Those analysts who sell advisory services based on Elliott's methods always come up with so-called alternate counts. They explain everything in hindsight, but are not reliable in dealing with the future. Fibonacci numbers and their ratios, especially 1.618, 2.618, and 4.236, express many relationships in nature. As Trudy Garland writes in her Lucid book Fascinating Fibonacci's, these numbers express the ratios between the diameters of neighboring spirals in a seashell and in a galaxy, the number of seeds in the adjacent rows of a sunflower, and so on. Elliott was the first to point out that these relationships also apply to the financial markets. Tony Plummer describes in his book Forecasting Financial Markets how he uses Fibonacci ratios to decide how far a breakout from a trading range is likely to carry. He measures the height of a trading range, trades in the direct tie-in of a breakout, and then looks for reversal targets by multiplying the height of the range by Fibonacci numbers. Experienced traders combine 266 risk management profit targets with other technical studies. They look for indicator signals at the projected turning points. If indicators diverge from a trend that is approaching a target, it reinforces the signal to get out. Trading on targets alone can be a tremendous ego boost, but the markets are too complex to be handled with a few simple numbers. Setting stops. Serious traders place stops the moment they enter a trade. As time passes, stops need to be adjusted to reduce the amount of money at risk, and a pro protect a bigger chunk of profit. Stops should be moved only one way, in the direction of the trade. We all like to hope that a trade will succeed, and a stop is a piece of reality that prevents traders from hanging on to empty hope. When you are long, you may keep your stops in place or raise them, but never lower them. When you are short, you may keep your stops in place or lower them, but never raise them. Cutting extra slack to a losing trade is a loser's game. If a trade is not working out, it shows that your analysis was flawed or the market has changed. Then it's time to ran fast. Serious traders use stops the way sailors use ratchets to take out the slack in their sails. Losers who move stops away from the market vote in favor of fantasy and against reality. Learning to place stops is like learning to drive defensively. Most of us learn the same techniques, and we adjust them to fit our personal styles. The following are the basic rules for placing stops. 1. Stop loss order. Place your stop the moment you enter a trade. Trading without a stop is like walking down Fifth Avenue in Manhattan without pants on. It can be done. I have seen people do it, but it is not worth the trouble. A stop will not protect you from a bad trading system. The best it could do is slow down the damage. A stop-loss order limits your risk, even though it does not always work. Sometimes prices gap through a stop. A stop is not a perfect tool, but it is the best defensive tool we have. 48. Exiting trades. 267. When you go long, place your stop below the latest minor support level. When you go short, place a stop above the latest minor resistance. See Section 20. The parabolic system, see Section 44, moves the stops in the direction of the trade, depending on the passage of time and changes in prices. If you use the triple screen trading system, see Section 43, place your stop after entering a trade at the extreme of the past 2 days range. Avoid all trades where a logical stop would expose more than 2% of your equity. This limit includes slippage and commissions. 2. Break even order underscore. The first few days in a trade are the hardest. You have done your home work, found a trade, and placed an order. It has been filled, and you placed a stop-loss order. There is not much else you can do. You are like a pilot, strapped into a seat for takeoff. The engines are blasting at full power, but the speed is low, and there is no room to maneuver. Just sit back and trust your system. As soon as prices start to move in your favor, move your stop to a break. Even level. When the takeoff is completed, your flight is at a safer stage. Now you get to choose between keeping your money or gaining more. instead of choosing between a loss and a gain. As a rule, prices have to move away from your entry point by more than the average daily range before you move your stop to a break-even level. It takes judgment and experience to know when to do it. When you move a stop to a break-even level, you increase the risk of a whipsaw. Amateurs often kick themselves for leaving money on the table. Many amateurs allow themselves only one entry into a trade. There is nothing wrong with re-entering a trade after getting stopped out. Professionals keep trying to get in until they get a good entry, using tight money management. 3. Protect profit order underscore. As prices continue to move in your favor, you have to protect your paper profits. Paper profit is real money treated with the same respect as money in your wallet. Risk only a portion of it as the price of staying in the trade. If you're a conservative trader, apply the 2% rule to your paper profits. This protect profit order is a money stop protecting your equity. 268. Risk management. Keep moving it in the direction of the trade so that no more than 2% of your growing equity is ever exposed. More aggressive traders use the 50% rule. If you follow it, half the paper profit is yours and half belongs to the market. You can mark the high high reached in a long trade or the lowest low reached in a short trade, and place your stop halfway between that point and your entry point. 4. Example, if prices move 10 points in your favor, place a stop to protect 5 points of profit. If in doubt, use the parabolic system. See section 44 to help you adjust your stops. When you're not sure whether to stay in a trade or not, take profits and reevaluate the situation from the sidelines. There is nothing wrong with exiting and re-entering a trade. People think much more clearly when they have no money at risk. After the trade, a trade does not end when you close out your position. You must analyze it and learn from it. Many traders throw their confirmation slips into a folder and go looking for the next trade. They miss an essential part of growing too. Become a professional trader. Review and self-analysis. Have you identified a good trade? Which indicators were useful and which did not work? How good was your entry? Was the initial stop too far or too close? Why and by how much? Did you move your stop to a break? Even level too early or too late? Were your protect profit stops too loose or too tight? Did you recognize the signals to exit a trade? What should you have done differently? What did you feel at the various stages of the trade? This analysis is an antidote against emotional trading. Ask yourself these and other questions and learn from your experiences. A cool, intelligent analysis does you more good than gloating about profits or wallowing in regrets. Start keeping a before and after notebook. Whenever you enter a posy, tie-in, print out the current charts. Paste them on the left page of your note. Book and jot down your main reasons for buying or shorting. Write down your plan for managing the trade. When you exit, print the charts again and paste them on the right page of your notebook. Write down your reasons for exiting and list what you did, right or wrong. You'll have a pictorial record of your trades and thoughts. This notebook will help you learn from the past and discover blind spots in your thinking. Learn from history and profit from your experiences. Afterward, one hot summer in the mountains of northern Italy, I sat down to draft the first outline of this book. 2.5 years later, on a frigid January in New York City, I printed out its last chart. I wrote and rewrote this book 3 times to make it clearer and to reflect my growing experience. I have changed as a person, and my methods continue to evolve. If I could work on this manuscript for another 2.5 years, it would become a different book, but it is time to let go. Pulling the trigger. Traders sometimes confide in me that they have trouble pulling the trig. Buying or selling when their methods tell them to go long or short. I had this problem once for a very short time. My friend Lou, to whom this book is dedicated, helped me get rid of it. One Sunday afternoon, I mentioned to Lou that I saw several attractive trades but doubted I'd take any of them the following week because I had recently gotten beat up in the markets. Lou, who is usually cool and mild-mannered, suddenly began yelling, "I want you to trade at the opening on Monday. I did not feel like trading. I was afraid of losing. I don't give a shit whether you win or lose. Trade tomorrow at the open. I seldom trade at the open, but I could trade 10 minutes later looking for an opening range. Breakout. 10 minutes is okay, but trade tomorrow. I thought about what had happened and realized what my problem was. I was like a skier at the top of the hill who had taken a bad spill and was afraid to go down again. Whatever my technique, if I was afraid to go downhill, I could not be a skier. Fear of placing an order is the biggest problem that a serious trader can. 269. 268 Risk management. Keep moving it in the direction of the trade so that no more than 2% of your growing equity is ever exposed. More aggressive traders use the 50% rule. If you follow it, half the paper profit is yours and half belongs to the market. You can mark the high, S high reached in a long trade, or the lowest low reached in a short trade, and place your stop halfway between that point and your entry point. 4. Example, if prices move 10 points in your favor, place a stop to protect 5 points of profit. If in doubt, use the parabolic system, see section 44, to help you adjust your stops. When you're not sure whether to stay in a trade or not, take profits and reevaluate the situation from the sidelines. There is nothing wrong with exiting and re-entering a trade. People think much more clearly when they have no money at risk. After the trade, a trade does not end when you close out your position. You must analyze it and lean from it. Many traders throw their confirmation slips into a folder and go looking for the next trade. They miss an essential part of growing too. Become a professional trader. Review and self-analysis. Have you identified a good trade? Which indicators were useful and which did not work? How good was your entry? Was the initial stop too far or too close? Why and by how much? Did you move your stop to a break? Even level too early or too late? Were your protect profit stops too loose or too tight? Did you recognize the signals to exit a trade? What should you have done differently? What did you feel at the various stages of the trade? This analysis is an antidote against emotional trading. Ask yourself these and other questions and lean from your experiences. A cool, intelligent analysis does you more good than gloating about profits or wallowing in regrets. Start keeping a before and after notebook. Whenever you enter a posy, print out the current charts. Paste them on the left page of your note. Book and jot down your main reasons for buying or shorting. Write down your plan for managing the trade. When you exit, print the charts again and paste them on the right page of your notebook. Write down your reasons for exiting and list what you did, right or wrong. You will have a pictorial record of your trades and thoughts. This notebook will help you lean from the past and discover blind spots in your thinking. Lean from history and profit from your experiences. Afterward, one hot summer in the mountains of northern Italy, I sat down to draft the first outline of this book. 2.5 years later, on a frigid January in New York City, I printed out its last chart. I wrote and rewrote this book 3 times to make it clearer and to reflect my growing experience. I have changed as a person, and my methods continue to evolve. If I could work on this manuscript for another 2.5 years, it would become a different book, but it is time to let go. Pulling the trigger. Traders sometimes confide in me that they have trouble pulling the trig. Buying or selling when their methods tell them to go long or short. I had this problem once for a very short time. My friend Lou, to whom this book is dedicated, helped me get rid of it. One Sunday afternoon, I mentioned to Lou that I saw several attractive trades but doubted I'd take any of them the following week because I had recently gotten beat up in the markets. Lou, who is usually cool and mild-mannered, suddenly began yelling, "I want you to trade at the opening on Monday." I did not feel like trading. I was afraid of losing. I don't give a shit whether you win or lose. Trade tomorrow at the open. I seldom trade at the open, but I could trade 10 minutes later looking for an opening range. Breakout. 10 minutes is okay, but trade tomorrow. I thought about what had happened and realized what my problem was. I Was like a skier at the top of the hill who had taken a bad spill and was afraid to go down again. Whatever my technique, if I was afraid to go downhill, I cannot be a skier. Fear of placing an order is the biggest problem that a serious trader can. 269. 270 afterward. Have. There is no way to handle this problem with ease and comfort. It has to be handled hard by a sheer effort of will, which is why Lou yelled at me. As a friend, you need to design a system or borrow one from this book and adapt it to your needs. Skiers do a little practice on a bunny slope, and you can paper, trade, design a sensible money management plan using the 2% rule. Limit your monthly losses to the maximum of 6% or 8% of your risk capital. At this point, you're like a skier ready at the top of the hill. Push off when your system flags you to go. Push off now. If you do not go downhill when the flag comes down, you might as well sell your skis and take up golf or raise goldfish. In other words, forget about trading. Now you have a system. You've learned money management rules. You know the psychological rules for cutting losses. Now you must trade. Can you? Traders try to weasel out of making this decision. They paper trade for years by automatic trading systems and so on. Several traders have even asked me to hypnotize them. These games must end. It is time to make an effort of will. Consider this book my friendly yell at you. The endless trail. Markets change, new opportunities emerge, and old ones melt away. Good. Traders are successful but humble people. They always lean. Being a trader is a lifelong challenge. I hope this book helps you to grow as a trader. If you have read this far, you must be serious about your work. Take this book for what it is, a description of what's on one trader's mind and how he goes about solving problems that all of us face. Take the ideas that appeal to you and shape them to fit your style. If you believe that being a trader is worth the effort, as I decided years ago, my best wishes to you. I continue to learn, and like any trader, I reserve the right to be smarter tomorrow than I am today. Acknowledgements. After finishing a project of several years, I owe a sweet debt of gratitude to hundreds of persons, teachers, friends, and clients. If you do not see your name here, please forgive me, and I'll thank you in person the next time we meet. Thanks, first of all, to all the clients of Financial Trading Seminars Incorporated. Often a phone would ring and a trader would ask for Dr. Elder's book. The book was not written yet, not advertised anywhere, but clients expected a book from me. That was terrific encouragement. Writing a book was a hard job, but it helped me organize my thoughts and become a better trader. Two friends provided a soft push at the birth of this project. First, Tim Slater invited me to seminars in Asia, and then Martin Pring introduced me to people at WIFA, which led to a conference in Italy. Walking with Tim through Snake Alley to a smoky restaurant in Taipei, and a few months later, sitting in a cafe in Milan with Martin, I felt friendly but unmistakable pressure to organize my thoughts and start writing. The blank screen of a word processor seemed huge and forbidding. To get the job rolling, I offered a number of seminars and taped some of them. Those transcripts helped me flesh out the ideas for this book. Thanks to all the analysts and traders in New York and Toronto, London, and Singapore, who came to my seminars, listened, and asked hundreds of questions. Some were experts whose comments forced me to stretch my mind farther than I expected. Others were beginners whose questions served as a reminder to keep my feet on the ground. I hope you're all making money trading. 3 persons, a colleague, and 2 patients have opened my mind to the idea of 12 steps, a major factor in my improvement as a trader. Thank you. Dagmar O'Connor, Jim S., and Kathy H. Kathy died last year after a long battle with cancer, and visiting her for months in a hospice reinforced my belief that there are values more important than money. Thanks to the pro. 271. 272 acknowledgements. Professional traders who came to consult with me as a psychiatrist and entrusted me with their confidence. You reinforce my conviction that if you get your head in order, money tends to flow in. Great thanks to everybody who works for my company, Financial Trading Seminars Incorporated. It is a unique group of people, intelligent, dynamic, and fun to be with. Each has been selected from dozens, if not hundreds of apply. Kants, you're the best. Thanks especially to our managers, Carol Keegan, Kane, and Inga Boguslavsky. Carol helped me edit every chapter. We had many passionate arguments about the language, most of which Carol won. And if you have any complaints about the clarity of this book, I'll give you her number. Once the manuscript was ready, I divided it into a dozen sections and mailed each to a top expert in the field. These busy and successful people found time to review several chapters each and suggested many improvements. In addition to the friends already mentioned, they included Gerald Appel, Stephen Breezy, Ralph Cato, Mark Douglas, John Ehlers, Perry Kaufman, Tony Plummer, Fred Schutzman, Bo Thunman, Ralph Vince, and David Weiss. Thank you for being so generous with your time and advice. If the market is a minus-sum game, then having friends like you is an asp. Silly big plus. Thanks to the analysts who wrote before me. It was often hard to find who was first. There is a thicket of conflicting claims in our field. As Henry Kissinger once said, academic fights are so bitter because the stakes are so small. Most charts in this book were drawn using CompuTrack software on an IBM-compatible and imported into PageMaker for the Macintosh. Thanks to Norbert Rudek for helping to set up the system and for unstinting phone support. Thanks to the editors at Barron's, Futures, Technical Analysis of Stocks and Commodities, Futures and Options World, and other mega zines for encouraging me to write articles and book and software reviews. It was a good training for the book. Many thanks to Stephen Reibel, MD, a fellow psychiatrist and a former boss at St. Luke's Roosevelt Hospital Center for covering my practice. I can go and teach all over the world knowing that my patients in New York are in good hands. Lou Taylor, to whom this book is dedicated, has offered a treasury of superb ideas. I wish he would write a book. His wise advice made a huge difference at several important turning points. My family, especially Miriam, Nicole, and Danny, provided cheerful support and a happy diversion from business. Acknowledgements 273. Finally, I want to thank my friend from way back when Nikolai Gorbunov, a scientist. He was destroyed by the Soviet system when I was but a teenager. In the closed, communist party-dominated world that we lived in, he planted a simple but revolutionary idea in my mind, that the only standard for research and work was the world class. You had to strive to be among the best in the world, or else it did not pay to try. Thank you, Nikolai, and thank you, all my friends. New York, November 1992. Dr. Alexander Elder. Sources: Angel George. Winning in the Futures Market, 1979. Chicago, Probus Publishing. 1990. Appel, Gerald. Day Trading with Gerald Appel. Video, New York, Financial Trading Seminars Incorporated, 1989. Arms, Richard W. Jr. The Arms Index, Homewood, Illinois. Business One, Irwin, 1988. Babcock, Bruce, Jr. The Dow Jones Irwin Guide to Commodity Trading Systems. Homewood, Illinois. Dow Jones Irwin, 1989. Balsera, Nazar J. Money Management Strategies for Future Traders, New York. John Wiley & Sons, 1992. Belleville, L.D. Charting Commodity Market Price Behavior, 1969. Homewood, I.L. Dow Jones Irwin, 1989. Bullish Review Newsletter, Rosemount, Minnesota. Club 3000 Newsletter, Augusta, Michigan. CompuTrack Software Manual, 1982. New Orleans, Louisiana. CompuTrack, 1991. Davis L.J. Buffet Take Stock, The New York Times, April 1, 1990. Diamond, Barbara, and Mark Collar. 24-Hour Trading, New York, John Wiley and Sons, 1989. Douglas, Mark. The Disciplined Trader, New York. New York Institute of Finance. 1990. Edwards, Robert D., and John McGee. Technical Analysis of Stock Trends, 1948. New York, New York Institute of Finance, 1992. Ehlers, John. Mesa and Trading Market Cycles. New York, John Wiley and Sons. 1992. Elder, Alexander. Directional System, Video, New York, Financial Trading. Seminars Incorporated, 1988. Elder Ray Video, New York, Financial Trading Seminars Incorporated, 1990. MACD and MACD Histogram, Video, New York, Financial Trading Seminars. Inc., 1988. Market Gurus, Futures and Options World, London, September 1990. Relative Strength Index, Video, New York, Financial Trading Seminars Incorporated. 1988. Stochastic, Video, New York, Financial Trading Seminars Incorporated, 1988.